Okay. Hey, how you doing, Larry?
All right. All right. Hanging in there.
Yeah. Hey, maybe you can riddle me this. You're an expert on the VIX. You know more than anyone I know, and myself included, about the volatility index. Why has the dang VIX been down for so long? It's a really sustained. Usually the VIX stays down in the dumps for maybe 4 weeks, but it's been down for a couple. It bounced over 22 yesterday, but the VIX has been real
Right.
low, uncharacteristically low for longer than I've ever seen it, and I have no
Right.
idea why. Any insights on that?
A little bit. I did some work lately. It's surprising that bear markets have a pretty steady historical volatility. It rises a little bit, but it doesn't really get too high. And VIX doesn't really deviate from the 20-day historical volatility very much at all. So what happens in bull markets, VIX, gets low and then explodes when something bad happens. In a bear market, kind of bad stuff is happening all the time. So everything's trading up in the 20s,
Yeah, yeah.
maybe the 30s. And it just doesn't get that boost. So like even in '07 and '08, up until the September of '08 when Lehman Brothers went under, up until then, it was the same sort of thing. VIX was really pretty subdued if you go back and look at it.
Yeah.
Same.
Good.
So it's been, and I went back and looked at the 73, 74 bear market,
Mm.
and the 20-day historical volatility rarely got above 30 in that market. Mostly it was down
Mm.
in the 20s. So,
Hmm.
so
Okay.
it's basically following more or less the 20-day historical volatility. Not exactly, but close enough. So it's not, VIX isn't going to go to 40 if the historical volatility is still in the 20s. It's just
Right, right.
not going to happen.
Yeah, because
So
like here you can see it, it spiked up, sawtooth, usually it's up and down, up and down, up and down. And the periodicity, that it's taken a lot longer to recover here lately than it's been throughout 2022, right? It bounced up every other month or so, but here it's been down for almost 3 months in a row. It hasn't broken 30 since back in September, so that's
right. Well,
that's
one of
it's
the
odd.
other problems too has been skew. I don't know if you have that chart, dollar sign skew. It's the CBOE's skew index of
I do not know, but I will pull it up and see if I do. Nope, I guess not. Nope.
no, SKEW. Sorry.
Okay. That one I'm not familiar with, but I always learn new things from you, so I appreciate that. Let's see if. Okay.
Yeah, so you can see how that's been in a huge downtrend
Hmm.
since last May.
Right.
So that's showing you how expensive out of the money puts are versus at the money puts.
Mm-hmm.
And expensive out of the money puts is what makes VIX go higher.
Right.
And they're just not there. There's just too many sellers of them right now.
Hmm.
All the pros sell them, and other people are not really buying them, or if they are, they're buying spreads, so you kind of have a buy and a sell at the same time.
Hmm.
So that's been a problem too.
Okay, that's
Um,
good to know. It looks like it's gonna have to break what 13,000 before. So if I'm hearing you right, I have no idea what skew is, but it looks like if there's that inverse correlation, this or correlation, this have to get over 13,000 before VIX would start to come back to life. If I read
right,
it right.
yeah,
Okay.
it's essentially the implied volatility of I believe a 20% out of the money put versus
Huh.
the implied volatility of an at the money put. So in a skewed situation, that is very high, but recently it's been low. So
Yeah. Yeah.
that harms VIX too,
Hmm.
because expensive out of the money puts, people panicking buying those things will make VIX go higher as well.
Yeah, and I also heard that zero DT options are somehow suppressing VIX volatility. I have no idea if that's correct or not, but you're
I
the
I
options expert. I
I
have no idea any of that.
I don't buy that for one
Okay.
minute. To
Okay,
me,
that's good to know.
that's not that's not
Okay.
even relevant. But I hear you that there are people saying that. I mean, it's just like yesterday there was an article on the zero DTE, and they said, oh, there was this big put purchase. Then the market went down, and it's Goldman. The guy from Goldman's writing this thing,
Yeah, yeah,
saying,
yeah.
"Looks to me like Goldman was front running a sell order.
Yeah.
What are you
Right, right.
talking
Yeah,
about?"
yeah. Yeah.
I mean,
Yeah.
it's not that the purchase of the puts made the market go down. It was done in advance of when they knew the market was going to go down. But
Right.
yeah,
Yeah, I know. It's always something out there. It's interesting to see where things are headed. But yeah, well, good to have you here, man. It's always good to have you with us, and good to see a good
yeah,
turnout here. It's
you got a good group today. I see Demarc is coming on. Was that?
No, we've got you, and then Tom. Normally, I'd have Tom speak at noon, but he's doing noon Central Time. So you're up first, and then I had somebody who was going to speak there, but they bowed out or they had to reschedule. So I'm filling in. Then Tom,
Okay.
then Toni, Anka, Norman, and Bennett. So yeah, it's good to see. I'm going to be doing these the last Saturday of every month for continuously from now on, kind of thing. So it's great to have you here. So
All right. Great.
yeah, we're about.
So make sure my presentation is ready to roll here. Yeah, it is.
Let
Okay.
me change if I can get this right. Let's see. I make you a co-host. I don't know what that does in terms of hopefully now letting you. How do I change you to presenter? Hmm. I hope I can get this right. Last time I did this, I haven't used Zoom for very long, but how do I change presenter permissions?
I'm not sure.
Let's see.
You're in Zoom now?
Yeah, normally, like last time, I did this when I clicked on these three dots. Oh, there's three dots at the bottom. Let's see. Well, it's not showing what it did last time. Last time when there's like three little buttons, the three dot thing, and when you click on it, it says it gives you the chance to. Let's see. I'll try and make you. I don't want to make you the host because that means
Yeah,
I'm not the host. But it's a. Is there anything in your? If you click on participants, can you click on the three dots? It says request presenter or something like that.
let's see. So I'm just seeing participants.
If you click on click on participants and then panelists, and hopefully there's and then next to your name somewhere on the right there should be like three little dots or something.
Oh yeah.
Okay. Is there anything that says request presenter or no?
It just says pin or rename.
Huh. And I don't know what that means. Let's see. Well, let me try making you the host.
Well, let's see. Here's another. No. I mean, it says I'm co-host, whatever that means.
Yeah, and I should be able to transfer the presenter status to you. Sorry, folks. Let me try and. See what this says.
Okay, I mean, you could just, I think, just have me do share screen, right?
Yeah. Google is my friend. Let me see what they say. They might have changed it.
If I click on share screen, it says this will stop other share screening. Do you want to continue? But I think.
Yeah, no, go ahead and do that. Yeah. Click whatever gives you opportunity to share screen. Oh, wait, it says you are screen sharing. Let me see if there's an option to change.
Okay, so you see my screen now?
Oh, yeah. You took it. Okay, so what did you do, Larry? Yeah,
I just clicked on, since I think we were co-hosts, it allowed me to share my screen and then cut you off from sharing yours. But eventually, up at the top, I see mine has a stop sharing. So when I'm done, I'll just stop sharing, and it'll go back to you.
Great. Okay, so what you did, and I apologize, I have to ask you this. Zoom changed their menu since last I did one of these. So you
clicked at the bottom. There was a green menu that said share screen. So I clicked that, and it said if you do this, you'll stop others from sharing, which is you.
Great. Right.
And so I went ahead, and now you can see me. And then when I'm done, I just have to hit stop share,
Okay,
and it'll
great.
go back to you, I think.
Okay, thanks. All this technology. Well, you got a wonderful looking. I really like that. It's a really sharp looking professional thing. So, anyway, traders, welcome aboard to our Trading Success Summit here for February 25th. Really pleased to have Larry McMillan, the world's top, or one of the world's top options experts with the best-selling options book in the world. Great to. I've been working with Larry for so many years. He's one of the nicest and smartest people I've worked with in the industry. So, Larry McMillan, take it away. Glad to have you here, man.
Well, thanks, Ken. All right, everyone. We're going to spend a little time here talking about the current state of the market, which I think is changing right now, or just recently. Just a little background on our company. I started out this company as a derivatives research firm back, 30 years ago, and we were selling research, making trading recommendations, etc. But then when we had a lot of success doing that, especially in 2008, we moved it to money management. So we're both a CTA and an RIA now. And then we also do a certain amount of option education, like this webinar, or like we have mentoring. Today I will come back to this later, but if you go to this link, optionstrategist.com/summit, you can download the PDFs and also get what we're calling the seminar bundle. I'll talk more about that later. So what do we look at when I'm looking at the market? Well, first and foremost, of course, the chart of the S&P 500. That's your baseline. If it's going up and your indicators are not in sync, then it's your indicators that are wrong, because the price is the price. The equity only put call ratios, we'll look at those. Market breadth, where we have an option twist, and then volatility indicators based around VIX. I have a very important rule, actually two rules. The first is oversold does not mean buy. So the market could get oversold and continue to fall for quite some time. And secondly, overbought does not mean sell. So the market can get overbought and still keep rising. So we wait for confirmed signals. I don't jump in just because something is overbought or oversold to reverse direction. So here's a 2-year chart of the S&P 500. And you can see the bear market downtrend line there, the top blue line here, this line right here we go, the line right there. And then more recently, we've established an uptrend line with, a higher low and higher high. So those ran into each other right here, form a peak on this rectangle. And we broke out on the upside, but now we've come all the way back down. And so that's not a good sign. For me, there was resistance here on this 4,100 level. We broke out above it, and now we've fallen back below it. The same sort of thing happened at the beginning of 2022. We broke out to new highs over what had been multiple resistance, and then fell right back below. So false upside breakouts are really negative things. And so to me, this returns the chart of the S&P 500 to a negative status. Things could change. And of course, if the chart were to change, we would change with it. But right now, this has reestablished a bearish pattern, in my opinion. Here's just zoom in a 1-year chart. One thing on this, you can see that there's this island reversal back here in August, which is still in effect. We rallied up to the bottom of that island, but couldn't get through, and that's where we just most recently had the failure. These little green numbers just shows you how strong rallies can be during a bear market, though. So the bears are always put under pressure. There's an old saying that no one makes money in a bear market because the bulls never sell. They just stubbornly hold on all the way down. And the bears keep getting too short and get wiped out by these rallies. And I suppose there is some truth to that. So you have to be a lot more nimble in a bear market. Anyway, in addition to just looking at the chart, we also draw what we call modified Bollinger Bands around the chart. And when John Bollinger invented Bollinger Band, he used the standard deviation of daily price changes, of closing prices as his definition of volatility, but the math guys, Black and Scholes and other people use the standard deviation of daily percentage price changes. So it gives you a slightly different size on the bands. So we just call that modified Bollinger Bands. And we look for the S&P index to move outside of plus or minus 4 standard deviations. And when it comes back inside, that's a signal. So this system has given us a lot of good trades over the years, but there were a lot of whipsaw kind of, noise in there. So we created what we call McMillan volatility bands, which require a secondary confirmation of the signal. So here's most recently, you can see this top band right here. That's the +4 sigma band. And then right inside that is the +3 sigma band. So you can see that in early February, we moved outside the 4 sigma and back inside the 3 sigma, and that gave us the sell signal, which is still in effect. The target for the sell signal is the -4 sigma band, which is right here. And, we're kind of close to that. We did touch the -3 sigma band yesterday when the market was at its lows. And so that would complete that sell signal. That wouldn't necessarily be a buy signal, though. Buy signal would have to set up. But you can see on the rest of the chart there, the red letters are successful signals. The one blue letter in the middle there, the B, that was a false buy signal that we lost money on that one. So every indicator doesn't work every time, but this is a pretty good one. And right now it's still on a sell signal. It was our first indicator to give a sell signal too, right there on February 3rd, right after the top actually. So just to kind of summarize our feeling or my feeling on the S&P chart, those false breakouts plus that the McMillan volatility band sell signal, that indicates to me that this is a bearish chart. There's resistance 41, 4200 where it couldn't break out, and then at the top of that island reversal is 4300. If we were to break out over there, that would be very bullish, but we haven't even come close to that yet. On the downside, there is support at 3900. And in fact, yesterday's low was 3940. But there's more important support in the December kind of trading range between 3760 and 3850. So basically, we're kind of in between these major numbers, but a move above 4300, as I said, would be very bullish. And a move below 3760, I think, would be extremely bearish. That would pretty much, the bulls would have to throw the towel in on that. Right now, the bulls are saying, oh, well, February's a seasonally negative month, so I'm not worried that the market, had this false breakout and failed to follow through. I'm a little worried about that, but apparently they're not. Anyway, we are maintaining a core bearish position, which means put spreads, and we will trade other buy signals around that when they occur. So I mentioned the McMillan volatility bands. We can actually calculate those on anything, stocks, ETFs, futures. And so we do that. And if you have an account or open an account, you can get the subscribe to the chart. So this is the S&P chart or the S&P 500, the same volatility bands. That was that false buy signal. Then there was the good buy signal, and then here's the most recent sell signal. You can see they appear on the chart there. So any chart would show these bands. That's a subscription service which you can find on our website. Anyways, let's move on to put call ratios. So we use the equity only put call ratio. That's all stock options that trade, in order to predict where the broad stock market is going. Put call ratios are a contrary indicator invented by Marty Zweig back in the 1950s. The theory is that too much put buying means the public is bearish and therefore the market will go up. Too much call buying means the public is bullish and the market will go down. So the way these signals occur is at local maximum or local minimum on charts. So here was a local maximum, and that's a buy signal for the stock market. And the top is the S&P 500 up here. And then down here, we just now formed a local minimum and that's a sell signal for the stock market. So we have a new sell signal based on the put call ratio. Now, this is just volume of options that are trading. If we include the price of the option, we get the dollar weighted put call ratio or just weighted put call ratio. This is usually gives it signals in about the same spots, but they're much more extreme. So this level up here, up in this level, that's about almost where we got to in March of 2020. Very, very pessimistic. And we formed a local maximum that's a buy signal. And we had the one in October and then followed that with one in December. They've been very good. But now we're down here. We've come all the way down to now we're at a very optimistic level. People are optimistic. The put call ratio is low, and we've just formed this local minimum new sell signal here. I marked these other two back here, the one in August and the one in April. You can see that the level of the put call ratio at those times was similar to where the level is now. And of course, those were pretty severe sell-offs, both of those last year. So this is a pretty negative indicator. So that just basically sums what I just said. How do we trade these signals? So basically, if you're a subscriber of ours, you know you recognize this pattern. But basically, I'm in the business of predicting the underlying. So I don't want to buy an option that's going to lose money, even if I'm right on the underlying. So that means I want to buy an option with a fairly high delta. So that would be an in the money option. So if I'm doing ITM, there's in the money. So if I'm doing a short-term trade, I want to buy something with a delta maybe as high as 70 or so. You know, that would be a slightly in the money SPY call, let's say, or SPY put if I'm trading the broad market. If I'm doing put call ratio charts of stocks and things, I might buy an at the money option, but still that has a delta of 0.55. So you see on TV, they're always spreading. Whenever they do an option trade, they spread it. And I don't know if that's the lawyers are making them do that, but in reality, that's not the best way to trade. In fact, you really don't want to spread bull spread or bear spread unless the options are expensive. So what do I mean by a bull spread? Let's say you're bullish on this stock and you buy a call at this strike right here. Then you know you would make money if the stock went up. But if you also sell a call at this strike right here, that's a bull spread, and that cuts off your profit potential when you get to this higher strike. Well, there's really no reason to do that unless, as I said, the options are expensive. Because what's really happening is this: the red line is owning a call, and it has unlimited profit potential on the upside. The black line is owning the bull spread. That's this one. Now, proponents of this always say, well, you know, you're risking less. You're not risking less. You're risking 100% of the cost of the trade in both situations. So if you're talking about less dollars, then buy a few less calls. So, you know, say instead of buying 5 bull spreads, buy 3 calls or something like that for the same amount of dollars. Then, you know, you would have the upside profit potential. If you are in an expensive situation, and I consider VIX to be in the 20s to be relatively expensive, then we, you know, most of our VIX spreads, our SPY spreads, we've been using bull or bear spreads. But you can mitigate the negative effect of spreading by once increasing the difference in the strikes. So in a SPY call spread, I would have the strikes 13 to 15 points apart. And in SPY put spread, because puts are more expensive than calls in SPY, it would be 25 to 40 points apart. And by more expensive, I mean in terms of implied volatility. And then in addition to that, if let's say you have a bull spread on, if the SPY rallies and hits your short strike, then roll the whole spread up. So because once you hit your short strike, you're just about to cut off all your remaining profit potential. Anyways, moving on, we do put call charts on individual stocks too. These are just a couple we're looking at right now. On individual stocks, I only use these signals that are way at the extremes, the local maximum, local minimum. So that I'm not using that one. You know, but here now, this was a very extreme local maximum. That was a good buy signal. And now we have ostensibly another one, a local maximum buy signal, but this stock has resistance at 83. So we're not going to buy it unless it can break through 83, and then we will. So sometimes we combine, modest technical analysis levels with the put call ratio signals. Here's another one, Celanese. We just got a sell signal here. It's had two good sell signals in the past year. Oh, that was one, and there was another. So we're looking here on this one, and here it's already broken the level. So we just went ahead and bought puts there when the put call ratio signal was confirmed. And then just one more, Oracle. This one also a sell signal, a local minimum here. This is actually happening around the first of the month, but Oracle has support at 86, and it has just not been able to break down through 86. I believe on Thursday it traded at 86, then bounced right back off of that. So here we're going to wait, and if it doesn't break 86, then we're not buying the puts. But if it does, we will buy puts on Oracle. Market breadth is the third thing we look at. That's just advances minus declines. We can keep a running total of that, or we can calculate an oscillator, and that's what we do. Now, there's two sets of data. One is New York Stock Exchange advances and declines, and of course, there's a million places to find that, but that includes some things that are not stocks. So we also calculate what we call stocks only advances and declines, and that's all optionable stocks. Now, right now, the set of optionable stocks is almost 6,000 stocks, so it's a pretty healthy and broad measure. So this is the oscillator. I'm not going to go over this whole chart because we're a little, short on time, but the red area is the overbought area, and the green area is oversold. Now, for 9 years, we were in a bull market, and so we weren't hardly ever oversold. But now we've advanced. We got into the bear market, so we got oversold quite a bit in the last year. We did have a buy signal right here. Remember, I said oversold does not mean buy. So we buy when it stops being oversold. And that was on December 29th. We got into this overbought condition, and that just popped back down through there. And that was a sell as of February 16th. So these indicators turned negative on February 16th. They're already oversold. The market had a very negative breadth this week, very negative again yesterday. But oversold, as I said, does not mean buy. So the market can continue to go down while this indicator is oversold. But, eventually it will give a buy signal. I'm just, you can't anticipate when. New highs versus new lows. This is something else we keep track of. Since last April, all the way through January of this year, this indicator was negative. But finally, new highs on the New York Stock Exchange started a number greater than 100, and were well above the number of new lows. So that was a buy signal. Now we're starting to weaken. You see that here currently, this is up to date. At the very bottom of this chart here, you're starting to see some negative numbers, some red numbers, especially from stocks only and NASDAQ, but even from New York Stock Exchange a little bit. So our definition is if you get two red numbers in a row, two net, new lows greater than new highs, 2 days in a row, that will stop out the buy signal. It's not a new sell signal, but we'll stop out that buy signal. So let's take a look at the VIX indicators, things around VIX. And see, you can't trade VIX. It's just an index, a very complicated calculation. But there are futures on VIX, and then there are options on those futures. So what you see as VIX options are really options on the VIX futures. You should understand that if you're going to trade those things. So the trend of VIX is important. The market should be trending opposite the way VIX is trending. And also spike peaks on the VIX chart are usually buy signals, especially in a bull market where people have these short periods of panic. Not so much in bear markets. So this is the current chart of VIX going back a year. And the red and orange letters are successful spike peak buy signals. The blue ones are not. So you see that as the bear market wore on, there start to be more and more of the blue ones, especially in here, although there was a nice buy signal at the October lows. This little area here is where the trend of VIX, the way we define it, went bullish, and that's still bullish. But VIX itself is now starting to rise. It's gone back into what we call spiking mode. So it will be giving another one of these spike peak buy signals here in the near term future. You can consider this an oversold condition. Again, oversold doesn't mean buy, so we're waiting for the buy signal. Here's your 200-day moving average of VIX right there. This buy signal is going to be in effect unless VIX goes above that. That 200-day is at 24.90. So it's not really close to the price of VIX, but it's not that far away either. So we're waiting for this buy signal. It will actually occur if VIX closes below 2063. That would give us the buy signal. That hasn't happened yet. As I said, this longer term buy signal is still in effect. Just a little bit of a broader perspective. If I'm going to back up the chart again, you can see that VIX bottomed here in the last year several times, right around 18, 19, and then rose as the market fell. So there's a contention that, this market, until the bear market is clearly over, VIX isn't going to go below 19 by too much. The traders who trade the S&P 500 options on the CBOE, which is what VIX is based on, that's big money. Those are expensive options, and big money is not always smart money, but it is a lot of the time. And so if they're worried about the market, you probably should too, which, leads to that question at the bottom there. Was VIX overbought recently when it was down around 19? There's plenty of people that think so. I guess we'll be finding out in the next few weeks or so. So, but as I said, you can't trade VIX, but you can't trade the VIX futures. So the VIX futures also give us some information. In a normal bullish market, if we look at the prices of the various futures, they line up in a rising fashion like that. So that's called the term structure. And when it's positive, that's bullish for the market. When it's negative, though, like this, where the futures, each futures contract is trading a lower price than the one before it, that's negative, and that's bearish for the market. So that happens, it's really happened badly in March of 2020. It hasn't happened so much in the last year. This bear market's been kind of steady. In any case, here's the current prices of VIX futures and VIX. So VIX is up here at 2167. The March future, which is going to expire in a couple of weeks, is trading at 22.25. So if we subtract 21.67, the price of VIX from that, we get 58 cents. So that future is trading at a 58-cent premium to VIX. You can see here in the front part, the futures are strictly going higher as we go to each one. Then it gets a little squiggly after that. But basically, this is still a roughly upward sloping term structure, and they're all trading at premiums to VIX. So that's bullish, modestly bullish anyways, for the stock market. Now, if you're not paying attention, you can find the future prices on the CFE website, which is CBOE Futures Exchange. But the CBOE also publishes several volatility indices, so that you can quote these right in your quote machine. You don't have to go look up the prices of futures. And there's a 9-day, which is a very short-term one, and that gets all excited every time we have a CPI number now or a PPI number. There's VIX, was normally 30-day, then a 3-month, 6-month, and 1 year. And you can see here that these are all sloping upwards. Each one's more expensive than the one before it. And so this term structure is also sloping upwards. And that's, modestly bullish too, really bullish. So the thing we're watching for here is a warning sign, and would be if the front month, March future, suddenly jumped up and went above the price of the second month, April future. Right now it's below, and as long as it's below, everything is good. If it goes above, though, you should immediately take some defensive action, because some of the most bearish moves in the last few years have been preceded by the 2 front month futures inverting anywhere from 1 to 4 or 5 days before the market collapses. It happened in late February of 2020 and several other times. Anyways, so summing this up, where do we stand? Well, on the bullish side of the ledger, we only have two things, the two things we just talked about, the construct of volatility derivatives and the trend of VIX. On the bearish side, we have a bunch of things though now. The chart of S&P, that's bearish in terms of the fact that it has those false breakouts. The breadth oscillators are still on sell signals, even though we saw they are now, or we're sold territory, but they're still on sell signals. The McMillan volatility band is on a sell signal, and the equity only put call ratios just went onto sell signals. That's really a very negative thing. I put the new high, new low indicator in the middle as kind of neutral because it has been on a buy, but it's definitely weakening now with the NASDAQ numbers getting into the red, and I expect the New York Stock Exchange numbers might follow as well. So just to conclude here, we're still maintaining a core bearish position, which is an out of the money put spread and SPY. And then we'll trade signals from these other indicators around it. So if we get the big spike peak buy signal or a breadth oscillator buy signal, we would trade those, but it wouldn't necessarily mean we give up our core bearish position. I mean, this market has been characterized by the fact that, both bulls and bears have failed to capitalize when they've had the opportunities, and nothing says that more than what's happened the last couple of months. There looked like a downside breakout, and that didn't happen. That would look like an upside breakout. That didn't happen. So we'll see where, if somebody's going to finally capitalize on an opportunity. Right now, I think the bears have that opportunity. Whether they'll actually capitalize on it or not, I don't know. Just one final chart here. This is the 73-74 bear market, which I think is very similar to this one, the one we've been in. We had this false breakout here. There was a high, broke out, and then collapsed. Went into a bear market, the trend line of the bear market, everything, big, sharp rallies all during there, but still a bear market. Then it broke the trend line and went higher, but that failed too. Then the oil embargo came along. The oil embargo ended. That caused a little bit of a rally, but really this entire area in here was a very negative time in the market. They were talking about the three I's: inflation, interest rates, and impeachment. Right now, I guess we have the two I's: inflation and interest rates. Anyway, eventually Nixon resigned rather than being impeached, and the market collapsed. Went into a new low in October. And I still think it's almost amusing, but Gerald Ford, who was then president, came out with his whip inflation now campaign, and they issued win buttons. If you have one, it's probably worth some money right now. I don't think too many people save there. Anyway, the market bottomed there and eventually tested that low, but then went higher. So even though inflation and interest rates were a problem for years after that, the bear market had ended. So I think this market is very similar. Where are we right now? I think we're right there. We broke the downtrend line, and then we went higher, but now we failed. We formed, right now that's that 4,100 to 4,200 area. Now we've broken back below it, and what would be catalyst later on? I don't know if it's going to be the debt ceiling problems coming up this summer or whatever, but I'm still thinking that it could be next October before this market really bottoms. So I said I was going to mention just this special we have. That's $249 for $800 value. You get 6 months of the Option Strategist newsletter, which is our prime weekly newsletter. We do have a couple of other ones. You get the book Options as a Strategic Investment autographed. Woohoo. And then you get the home study course, which is a 14 series webinar, each one lasting between an hour and a half and 3 hours. And then a free money asset management consultation. So I invite you to stop by that website, optionstrategist.com/summit. And just that's you can download the PDF there too. Come by our YouTube channel too if you want sometime. So Ken, I'm going to turn it back to you.
Yeah, well, thanks so much, Larry. And you're one of the top, rare praise but honest and candid. You're one of the top 5 guys in the whole industry, in my opinion. So, Larry McMillan, he's a total expert. So the well runs deep, and you know your stuff. So thank you very much for an outstanding presentation. It means a lot to me. I always pick up new things from you, so I appreciate it.
Right. Okay. I stopped the share, so it should be back to you.
Okay. Can everyone see my charts on the screen now? I'm just curious.
No, I think you have to share your screen now.
Okay, thanks. I'm new to this whole Zoom thingy. Okay.
There you go.
Can everyone see this okay?
Traders.
Okay, thanks. Well, thanks, Larry. Appreciate it.
All right. Good luck.
Thanks so much. Appreciate
Thanks.
it.
Mm-hmm.
So welcome aboard, traders. It's a real honor to have industry top people. Do you guys like the 30-minute format? I know it kind of puts people, they have to be in rush mode, but if you're like me, short attention span, I'm a day trader. It's an occupational hazard. Does everyone like the 30-minute? We're doing these the last Saturday of each month. We did have another speaker scheduled for now, but he had to reschedule, so I'm subbing. I'm in here for you guys right now, and we're going to get underway. The first thing I wanted to share with you is something to build credibility. Why listen to Ken Calhoun? Okay, well, I've been doing this for a while. The main thing is I did over 124 million worth of real money trades last year. Let me hit the video here. How many other educators did that with P&L proof, baby? Boom. Hey, so good morning, active traders. I'm Ken Calhoun, president of the original Day Trading University and now Trade Mastery. Because I had so many swing traders, I didn't want to make it just day trading focus. Anyway, I've done a lot of trades, a lot to learn. And one of the things that I wanted to share with you is not only the authenticity of learning from somebody who actually really trades a lot. One thing that I like that Tom Sosnoff says is trade small, trade often. And that's brilliant. I completely agree. Any professional trader will affirm that. That's the right way to trade. You throw a lot of darts. My biggest profitable years, I'm seldom right more than 30% of the trades. And that's kind of an eye-opener for a lot of home traders. You don't have to be right over 50% of your trades to make money. That tells me that you'd be a total amateur and you lose money. Any floor trader will tell you the percentage of winning trades is irrelevant. What counts is were your wins bigger than your stops. So I throw a lot of darts. When I day trade, for example, my average stop loss cost is under $40, $50 per trade. I may do several dozen trades a day, like 500 shares with a 5 to 10 cent stop. So really teeny tight stops. And of course, you want the wins to add up to more than that. So why learn from me? P&L proof. Let me ask you a quick question. How many do you think it might be a good idea to start asking educators for proof that they actually really trade? I think it's kind of important. So that's just one of my pet peeves. My biggest winning swing trade in recent history was cold, KOLD. Anyone else trade cold? My members were thrilled with this. I was giving them in my live trading room long alerts from around, I bought 21 and I sold 63. Now this is in my interactive brokers account. I've got accounts with TD Ameritrade. Mostly I trade in Fidelity, but I have Ameritrade, IB, and Fidelity. Anyway, I knocked it out of the park with this one. I bought 21 and I sold 63. Anyone else trade these instruments? I'm just curious. Let's see, I'm trying to get the participants window on. Good. Okay, anyway, what was the setup? Let's take a look. One of the most important things you'll learn as an experienced trader is range is everything. The most important factor, I used to be a statistician for Ford Motor Company. I'm a UCLA grad. I've got a couple degrees. My wife's from Japan and she says I'm an otaku, which means computer nerd. Nerds rule the world. Anyway, that's fine. It's all about the numbers. The math is more important than the chart pattern. Your exits are more important than your entries. Kind of turns things on its head. I nailed this over the 20 because I had a bullish cup here, and it looked a little oversold to me because it had been way actually even higher than this. Boyle is up next to bat. Whenever you evaluate a swing trading chart, one of the good things to look at is not only buying strength, buy high, sell higher, but for weak charts, and you're looking at buy low and sell high like I did on this one, make sure there's a significant range to work with on the right side of the chart. So for example, inverse NAC acid come down, and there's still lots of room to run, by the way, so I will get back into this on new highs. I'm sitting it out right now, though, because I think it's Boyle's time to run. It's the opposite of cold, okay? One thing to look at is institutional volume. Do you see the big green volume spike there lately? If like Larry's alluding to, say big money is usually smart money. Traders vote with volume. When you see a really huge green candle in volume or green bar in volume like that, that means two things are happening. One is you have a short squeeze, right? Everyone who's been short in this made a fortune likely, and they're covering their shorts. Now, how do you know when to get in? I like to use 2-day highs, multiple day highs. The first thing to make money as a trader? I'll tell you, I know how to make money as a trader. I've done it for years. Trade the risk, like my colleague Steve Nissen says, another one in the top 5 of the short list, risk reward. There's minimal risk in this chart and a whole lot of reward. Now, a lot of time your commodity plays, whether it's oil or gold or silver, or in this case, natural gas, there's a lot of upside in this one. So I'm really excited about BOIL. And we take a look at some of the trade volatility. One thing to look for, by the way, for a pivot is a pattern of, let's see, in this chart, I like to see 3 green candles. And kind of like there's a candlestick pattern. I think it's called 3 white soldiers. To learn candlesticks, learn exclusively from Steve Nissen. He's the only guy you should learn from for candles. He knows the stuff. Everyone else has kind of read his books and copied them. Well, why don't go out like that, because the copycats don't know anything, and traders make bad decisions. Learn from real experts. Anyway, 3 green candles in a row. We don't have increasing volume, but we have heavy volume. We still have heavy volume and a slight uptrend in this instrument. And if you kind of zoom in on this, that's a good example of a very clean, this is a 2-day chart. We have a nice, clean, continuous run up in our Boyle chart. So my biggest day trade win yesterday was just nailing this on the pivot here, and selling at 93, I think it was. Anyway, when it comes to swing trading, you want charts that have a continuous, close to 45-degree angle breakout for multiple days. And so if you take a look at this, we pull back the properties and we look at a few days. One signal to look at for swing trades, and this is a rider downer, always only add at end of day highs, okay? Only add, and this is very true, it's very honest, you can put on a swing trading entry in the beginning portion of the day, but you may have heard that saying, amateurs control the open, professionals trade the close. Your big money traders, the guys who run the biggest funds out there, their order flow is usually between 3:15 and 4. I know I used to have institutional clients. The money, it goes into the close. As a swing trader, write this down and test it. I'm sure you'll be thrilled with the outcome. Only add to a trade or keep a trade alive if it ends the day above the previous day's high. So previous day's range is here. You want to hold on to it and scale in at the end of day between 3:30 and 4 at a 2-day high. When you have a nice continuous trend like this, that's the best kind of trend. Straight up and down usually does mean reversion, pullback, and iffy and choppy. What you want instead is a nice, clean, continuous uptrend. And 3 days, there's a kind of a 3-day rule. Some of my Wall Street guys were taught me this back when I was doing live seminars at MGM Grand in Vegas and so forth. I'd have a lot of institutional, the market makers and the specs would come out. You may have seen video testimonials from some of them on my trademastery.com website. 3 days. 3 days defines initial reversal of trend. So it needs to be 3 days minimum before you start throwing darts at it. So it's not at a breakout trigger yet, but it looks good because we have 3 days in a row. And again, on this particular chart, it illustrates the concept of going in above the high. One other thing to look at, you may have seen my article in this month's issue of Stocks and Commodities magazine, the 10 o'clock reversal. It's very, very consistent. If you've been in my live room for the last 20 years, you know that that's one of the patterns we count on. For proof, go back and look at all your charts over the last month. You'll almost always see a reversal at 10 o'clock. That's something very few people know, except the pros. So the market often, and if you look at the S&P, and the Spiders ETF here, dun, 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 dun. Hey, look, it reversed at 10 o'clock. Hey, look, it reversed downward at 10 o'clock. It usually reverses the prevailing trend. Whatever the last between 9:45 and 10 o'clock, you almost always get a pivot 10 o'clock, give or take a few minutes. So be on the lookout for that if you're a day trader or a swing trader. If you get stopped out, and you're frustrated being stopped out frequently, as we all have in our past, at least, or some of you maybe presently, avoid false breakouts by not entering at a timing reversal window. Usually you get a reversal at 10 o'clock, one near lunchtime, if there's going to be one, and then one around 3 o'clock when the bond market closes. So be aware of those timing intervals if you're a day trader especially. If you're a swing trader, pay attention to charts that make sense. So close here. Now let's take a look at the VIX, okay? So here I bought 21 and I sold 63. And the reason I sold 63 was what? Who can name that candle? Now you don't see, I guess, how to say, you don't see candle reversal signals at every reversal, but when you do see them, they should be paid attention to because they're very consistent. Right. Thanks, Bob, Alvarez, Neil, Tim. It's a shooting star, right? It's a box with a stick on the top. You sell underneath the low on a subsequent day. So I sold 63. Now, frankly, I was a little surprised it ran up here. Not surprised it came back down. I think that's stick a fork in it, it's done. The opposite is boil, right? And that's the thing. Oh yeah, by the way, not a trade recommendation, but you might want to short Bitcoin with BITI. BITI. It's an ETF that shorts Bitcoin. I'm long right now, and you can see, boom, flawless victory. We have it's hammer time. Anyway, it's hammer time. You go long above the high of the hammer, put a hard stop underneath, right? 3 green candles. Now this illustrates another pattern I want you to write down, and that's small followed by a large horizontal body candle. In any kind of trend, often you'll see a small expanding ranges. So you have a small candle, and by larger, I mean at least 50% or so. So if the previous range was 10, the current range should be 15 kind of thing. So if you have a small followed by a larger horizontal body candle, either on a pivot or a breakout, that's usually a long signal above the high. So I'll be scaling in at 28, I'll build at 30, 32, etc. One thing I want you to think about too, as an accurate trader, as a successful trader, one of the things I always like to share is every trade should be seen as a sequence. Every trade should not be seen as a pull the money in the slot machine, ding, 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 ding. No, it's a sequence, much like playing Hold'em. I won my first Hold'em tournament in Vegas almost 8 years ago. It's a long time ago. Anyway, it's a sequence of hands, right? You got your flop, you turn in your river. As a trader, each trade, every decision you make as a trader should be seen as a sequence of 2 or 3 trades. You should always be looking. The first trade is your get started trade, like planting a seed. Second trade is either stop out or scale in. Third trade should hopefully be another scale in. So, my biggest money trades are always ones in which I build the trade. You feed the winners and you starve the losers, right? At each incremental new high, you always want to scale in. So anyway, that's a quick tip. Bitcoin short, BITI on a bounce. If you look at the intraday, you can see it's a nice gap up yesterday, a nice breakout. So kind of head steady and spikes up. So just like I was on cold, I like boil for a swing trade. And if you look at the daily chart on this one, you can see that we've got a nice uptrend. Okay, now it's nice 3 days. And if you look at the 1 month, kind of zoom in on this, this chart is still in a declining pattern. I think it's the only reason I bought it lately is because I think the cold is overextended. So and like Larry was saying too, very smart. You don't make the decision just because of the extension, but you start putting a plan together if it meets your criteria. So for me, I'm the whole number guy. So I always put on trades on size just above each incremental whole number. So I will scale in over 7, I'll scale in over 8, I'll scale in not over 9, but over 10. Another quick tip, don't buy 9s because often that acts as psychological resistance. I had some really good charts yesterday when I was doing a show or a presentation for Metastock, and had really good patterns that illustrated the fact that you really don't want to buy anything with a 9 in it. Now, with an increase in the VIX lately, of course, I like trading UVXY and VXX and whatnot. I successfully traded VXX on the flash crash day, 15 years ago, and I got out. I had a phone call with Steve Nissen later that day, and I sold because there's a shooting star in the intraday at the exact top, and I nailed it, and I told Steve that. So learn from people, like Larry McMillan, Steve Nissen, Tom Sosnoff, Harry Boxer, some who know their stuff. It can actually really help. So anyway, this is our UVXY. It's in an uptrend the last 3 weeks. Okay, so the 52-week low is the 445-ish, something like that, the 440s. And so a breakout above each whole number makes sense to scale in. Now, VIX has been down, and this has been down significantly lately. I think that's oversold. Doesn't necessarily mean buy yet, but puts it on my radar. And the fact that we're starting to see it lift up and hold its own the last 2 weeks gives me confidence that this will likely be up here within maybe 2 weeks, 3 weeks. So remember I said that my two top picks, actually my three top picks would be Boyle, and this one UVXY, and BITI. The fourth one is SOX's, or semiconductor inverse, and it's doing a nice pivot here off the decade value, off the 20. Because Wall Street is controlled by high frequency trading algorithms, HFT algos, you can often predict correctly by knowing what to look for, the signals that those folks use. And oftentimes you'll see things like support and resistance at right under decade values. So I never buy a 9, right? Because 9s usually false breakout and drop. Never buy a 9. It's always an epic fail. How about Tesla? I correctly called Tesla short, and it's true. I posted on a forum. I even called the Chiefs by 3 on the Super Bowl. I wish I'd bet it, but I'm not familiar with sports betting. But before the game, I called the Chiefs by 3. And what's up with that end of game call? Anyway, I digress. Tesla I called short at 811 2 years ago. I ran all the way down to 100. Another good example of psychological support resistance at the decades, or in this case, the century numbers, right? We have 100 support, 200 resistance. The way that I teach, I'm a professional pattern day trader. I come from a production environment. In manufacturing, we use what's called control charts. If you're from a production background, use CPK values and you're trying to get close to nominal in your specs. In manufacturing, we try to drive out variation. We want to compress, we want all the widgets to come out the same exact size, so that way they don't misfit and wear out, grossly oversimplifying it. But in trading, we want the exact opposite. We want wildly out of control, spiking or dropping charts because we want to trade, right? We don't like flat, we like trend. Anyway, combined with that, visually, 100 support, 200 resistance. It's kind of like, the way that I teach, it's a lot like one of my traders that told me this years ago, beautiful young woman from France, I think it was. Anyway, I digress. It's a lot like those hidden word puzzles. Like back when I used to travel as a consultant around the country, I was a consultant to a lot of Fortune 500s for quality management. I'm internationally published in ASQC back in the 80s. I'm almost 60. I'm 59. How did that happen? What the F? Well, anyway, it's like those word search puzzles that you see in the magazines that we used to get at the news stores near airports. I know this is old school, but to kill time, I'd get the word search puzzles and have all those alphabet letters and you have to circle the words. That's a lot like trading. You want to be able to visually understand patterns that are repetitive that you can capitalize on. So the 10 o'clock pivot, that's a good one as well. All right. Let's see. So everybody can see my whole charts, right? All right, let's see what else we have. Anyway, the cold. Let's walk through this just briefly, and then we'll move on. I've only got a few minutes left, and then Tom Sosnoff is up. And I will be speaking at the Money Show event in April, on April 26th in the afternoon. So be sure to be there if you can. I haven't been at a Money Show in 7 years, I think, a long time ago. Anyway, we've got Tom Sosnoff, Toni Hansen, Anka, Metcalf, Norm, Hallett, and Bennett, McDowell coming up later today for you as well. And again, normally I would not be speaking this early, but one of my speakers had to cancel out, so I've instead of speaking last, I filled in for him. So what another few things. Never enter inside charts, or I should say never say never. Seldom should one enter a chart in which it is inside the previous day's trading range. You may have seen my Stocks and Commodities magazine article. I have kind of an inverted traffic light. It's red at the bottom, yellow caution in the middle in the previous day's range, and green at the high. So you want to scale into a trade. And think of how much money you could have made, like I did. I tripled my money I literally tripled my freaking money, which is a good play at night because I knew it was oversold. So, and I got stopped out a few times, by the way. It's not like I just had one winning trade and I was lucky. No, the story of trading is the story of frustration, of anger, of missed opportunities, of stop losses taken. Whenever I do my money show events, I always, in front of standing room only crowds, hundreds of people, I always say, how many of you, and I'm going to ask you this right now, how many of you have ever concealed, hidden a trading loss from your significant other, whether that's your wife, your husband, or your pet dog? You've hidden, you've not discussed your trading loss. If that sounds like you might have a problem. It's like gambling 101. If you want to turn all that crap around, figure out what the gold standard is, like the type of things that I and some other top people teach you. What does when I asked traders yesterday, when I was doing a presentation for another organization, I asked them, give me some of your charts. What are some charts that you would like to ask me whether or not I would trade? And in the beginning, every single chart was terrible. They're flat, choppy charts. I'm saying, how can you expect to make money with that kind of chart? Really? You're trading that. You're going to ask me, I wouldn't touch it with the 10-foot pole. It's just a horrible chart. And then eventually learning occurred, and then people asked about rock star charts, the great charts, like this one was up until 63. So one thing I want you to learn is don't trade inside the previous day's range. Let me put up the interval chart here so you can see what I mean. So for example, I like BITI because it closed above the previous day's high. This is a 2-day chart here, left, right, 2-day charts. Anyway, thou shalt not buy inside previous day's ranges, right? Oil looks good. Now, I would not have bought it for a swing if it had closed the day under the high inside the range. There's in days and out days. Institutional money flow is much amplified and worth trading specifically and exclusively on out days. So I don't like to trade the S&P when it's inside the previous day's range. It's choppy as heck and not worth trading. When it's under the previous day's low, great, I short, or I buy inverses more accurately. Or if it's above the previous day's high, I'll go long on gap continuation breakouts. But out of every 5-day trading week, there's usually at most 2, maybe 3 days that are actually worth trading in the first place. Often there's just 1 or maybe 2. Every day is not worth trading. The simplest and easiest way to recognize tradable days are to see which days are out of the previous day's range. So for example, if we look at this chart of the spiders, the S&P here, and we take a look at last week, let's take a look at, say, 10 days. This is the stock market. Now, one thing I want you to do is completely ignore the stupid talking heads on TV. Let's buy quality oversold stocks that have dividends and they're actually making it. No. Thank you for playing. Johnny, tell them what they want. No. Follow the trend, okay? The trend's your friend. So choppy, no. Down, okay, on the open. Down, yes, trading. Yeah, yes, worth trading. Here, choppy, not so much. Here, up, not so much. This day, yes, on the low. Out of each sequence, you want to trade out of the previous day's range. That's where you at least position size or scale only when things are outside the prior ranges. So for example, I like going long the SQs, right? That's how to short the NASDAQ, and which days are inside. I only got a few minutes here. What are in days and which are out days? Okay, that's an in day, that's crap. That's an in day. It ended out, so if you were buying this would be a buy signal because it's ended the day above the previous day's high. So that's a long signal. Everybody get that? This is an out day. That said to buy me here. Not bite me, but buy me, baby. Boom. And look at that. Ba-da-dum, ba-dum. That's an out day. That said buy me. That's an inside day. No buy. No happy ending for you. That's an inside up and down day. No buy. That's an out day. That is a buy. Very easy to understand what to look for once you know the signals of what the patterns are that make sense to trade. And hopefully the good thing is what I'm trying to cover, 2 decades and a lot of experience with you, are things that are relatively easy to spot in your charts. Now again, I did 124 million worth of trades last year. Proof, that's my Fidelity. That's just in my Fidelity account. That's the 99% of my trades. But anyway, I've done a lot of trading, and hopefully I can help you figure out the difference between. That's my credibility, my reputation is all built on my ability to teach folks the difference, the delta between what sucks and what rocks, what's good, what's not, what wins, what loses. And a lot of it is looking at the range, the directional volatility, and the math behind the chart. And look at your trades as a sequence of trades as well. All right, so like all that jazz. We got Tom Sosnoff coming up in just a minute. I'm going to place a whole jazz set for you guys after the end of our session today. Anyway, I can play better than that, but that's just off the top of my head. Improvisation is a lot of fun, but not in trading. Trading, you got to be a rules-based trader. So trading with all that jazz, I want to make sure that we're looking at out charts. And again, learn from people who actually frickin' trade, know what they're talking about. Like Sosnoff, he's one of the top guys in the whole industry. He says, trade small, trade often. That's how I make money. I may be wrong like 70% of the time, but 74% of the time to be accurate. But when your wins outdo your stops, that's how you do. You throw a lot of darts and scale on the ones that work. Take anybody stops on the ones that don't. Anyway, what else? I think we're about ready to learn from Tom Sosnoff. Tom, how are you doing, sir? Hello, Tom. Tom's here.
One sec. There you go.
Hey, Tom, how you doing?
I'm doing great. I just I'm logging on right now. I just had the wrong username, but
okay, I'll make you a co-host, and then you can click on the share screen. I just started an account with you guys. I just applied for an account last week, so eager to see how the plan is. Do I have a right? You guys have commission-free equity trades? That's good. Nobody knows that, or I didn't know that till I checked. So
we don't
advertise that much.
We don't make a big. Well, we've had it for years now. I mean, actually, we've had it from the day we launched. So January 1st, 2017, we've never charged for equity trades. It's funny, in the industry, they everybody talks about I mean, people don't really talk about the fact that brokerage firms lose money every time somebody trades the stock.
Yeah.
It's kind of crazy, but
we get order flow, so that's something, I guess. But I don't know if it nets out.
Yeah, plus, I don't think people understand what payment for order flow really is, because when it comes to payment, we get about 15 cents per 1,000 shares.
Okay.
So it doesn't really pay. It doesn't pay.
Doesn't pay. Okay. Well, it's a good to know though. And one of these days I'll get hip to trading options too. It just makes my head melt. I'm a price action simple guy. I throw darts. But you and Larry McMillan, two of the top options guys in the world. So good to have you here. And I appreciate you showing up, man. Always good to have you're in my top 5 list of the people worth learning from out there in the world, the trading world as well. I don't know if you're going to be at Vegas in April. I'm going to be speaking there too. So
I don't know what's in Vegas. I'm not sure.
The money show's doing the expo and.
No, we've been doing the virtual money shows, but not the in-person ones. It's just, but I am back out on the road. So
okay,
I'm doing 11 events this year around the country and around the world. So I shouldn't say 11. I'm probably doing closer to 16 events everywhere. So I'm
you're out there.
I'm like poop. I'm all over the place.
Oh, you're worth learning from. You're good. You know your stuff. So it's whenever, for all of you who haven't seen Tom, he's great at money show events. It's always a standing room only crowd and people in the back can't find seats and all that. So anyway, Tom Sosnoff from Tasty Live. Let's see. You should be able to click on share and take over. Hey, there you are. I see your face. There you are, sir.
Let's see. Share screen.
Yeah, you can click share. Yeah, that's what Larry's telling me works. Let's see. Yeah, just click on where it says share, the little, there you go.
There, I should be fine.
You are fine, sir. And thank you very much. I really appreciate it, Tom. You're one of the world's top experts in the whole industry. You are. So it's honored to have you here, man. And thanks on behalf of all of our traders who are here as well. Take it away. Appreciate you for being here, man.
That's great. That's great. Yeah, I haven't seen Larry in a while since the beginning of the pandemic, but I'm glad everybody's still going strong. And is he on next after me?
No, he was up.
Oh, he was up already. Awesome.
Yeah. So you're our keynote. So welcome aboard, man.
Oh, okay. All right. Well, this is awesome. So thanks, Ken, and obviously thanks everybody. This is always a treat. I know you're going to think that's probably crazy after all these years and doing the same kind of stuff, but honestly, it never gets old. I know that's like the weirdest thing ever. But just to give you 2 seconds of background, and I'll also just follow up on what I mentioned to Ken a minute ago. I've known Ken now for, I don't know, just probably met at a money show or something, 20 years ago, and I've met a lot of you over the years at money shows, traders expos, tasty events, old Thinkorswim events, all that kind of stuff over the years. So it's a relatively small community of traders, which hopefully is going to continue to grow, but it's super cool just to be part of it. I have been on the road speaking and building software for the last 22 years. We started building Thinkorswim in 1999, and we sold it in 2009. I started Tasty in 2010, and then we've been going strong as Tasty for the last, we're going basically into our 13th year. So it's been, a real amazing journey, and I hope it goes on forever. Before we built Thinkorswim, I was a market maker on the floor of the SIBO for just about 20 years, started in 1981-ish. I don't remember the exact start date, but we've been pretty much going strong in the world of options now for a little over 4 decades. And early in my career, I was primarily an index trader. I traded the S&P 100, which doesn't really trade that much anymore. It's pretty much a dead product, but at the time it was the largest trading vehicle in the world. Now the S&P 500 is basically the same type of thing. But what I used to do, the market making like I used to do, is that game doesn't exist anymore. Today's world is a world of tight, efficient markets, high frequency trading, and the counterparty is almost 100% of the time is basically a server. And so there's an incredible upside to that. And the upside is that it means you get to do whatever it is you want to do. And for the last 20 years, we've been building some really cool companies and building some amazing front end, trading software, and it's really become my passion. And also, like Ken mentioned, teaching about it and things like that. We don't actually even sell anything or anything like that. We just build software and hope that, and we give away tons and tons of content, and we're like a think tank. And my goal is to create technology and content that optimizes the decisions that you make. It's actually more than optimization. My goal is to facilitate opportunity for all investors, and I don't care what that means to you, whether you're hyperactive, active, passive, everything. My goal is to build technology that lets you do whatever it is that you want to do. I believe there should be no restrictions. I'm a pure free market capitalist and believe that there's there should be no restrictions with respect to what strategy you choose, what product you trade, how you trade it, and any of that kind of stuff. I also, in addition to building technology, really think that it's important to deliver content that doesn't try to do what we're not capable of doing. What I mean by that is, I'm not going to try to ever tell you, what I think is going to happen tomorrow. Like, I mean, obviously I'm opinionated. Obviously I have an opinion on everything from Bitcoin to copper, to silver, to almost any stock you can imagine. I'm opinionated, but the reality of that is that what I really like to do for people is to give you takeaways on how to optimize whatever it is, whatever your assumption is. And so just think about it this way. If you believe like I do, I'm an efficient market theorist, and I believe that all prices are fair. There's no theoretical edge anywhere in the markets. There's too much money chasing too small returns. And so if you believe that prices are fair, then there has to be like a little bit of, like which strike do I choose? Which month do I choose? What's the best way with the highest probability of success to get long? Where in the decay curve is my position most optimized? Where do I get myself in the most trouble? Where do I have the best opportunity of success? And all of the above. That's all about scale, longevity, all that kind of stuff. So that's what my life has become. And that's what I really do now, basically about 15 hours a day still. So, and that pretty much includes weekends too. I'm a junkie. So what I thought I would do today, because I think we're kind of through earnings season. We've kind of had, we've had an interesting first 2 months to the year where we're barely we're a little bit over where we started, but we're not that much has happened. And we just had a nice sell-off. And there's, based on my emails, there's people that think, hey, certain things are expensive, certain things are cheap. But what I was going to do today, because I only have a short period of time, I only have 30 minutes. What I was going to do is just talk about possibly some stocks that I think, okay, this is not, and again, I'm not a technician, I'm not a fundamental analyst or anything like that, but stocks where I want to skew a little bit to the upside. Because right now, when you think about it, we've had a really nice sell-off down from what, 4,200-ish down to 39.50. We traded under 39.50 on Friday. So that's a pretty good sell-off of about 250, 200, 240, 50, 60 points, which with a $4,000 SPX price or S&P 500 price, that's about a 6%, maybe even 6.5% sell-off from the highs. I kind of like that. So there's a lot of stocks out there that are, I'm not going to say they're cheap at all, because they're not cheap, but they're interesting. Okay. And so then what happens when you find a stock that, that you think is interesting, right? That's a totally fair question. That's a fun question. And so I thought I would start off with, and again, we can go any direction. I have no axe to grind, except that I like to focus. So one of my most important focuses is on liquidity. I have two things that my eyes gravitate towards all the time. One is liquidity, because I don't trade illiquid underlyings. There's no reason to trade anything that's illiquid. There is so much money and so much flow now that there's no reason to do anything where the underlying's not liquid. So that's number one. You have to find something liquid. And number two is I need to have reasonable volatility. I prefer high volatility, but sometimes it's hard to find high volatility because the market's normalized volatility after a really expensive year in pricing last year. So I'm looking for what I would call relatively high volatility. So we're looking for liquidity and relatively high volatility. And then when you find that, then the next part, the assumption is subjective, because nobody knows for sure. Like I pulled up Google on the screen in front of you. This is the Tastyworks platform. This is the platform that we built. And we just changed the name actually to Tasty Trade. This is the fastest growing platform in the world right now, derivatives platform. And in my opinion, of course I'm biased because we built it, but it's also the best platform in the world. It's the only high frequency platform, meaning that individual users get to trade on a high frequency technology, which means 20, 25 millisecond fills, that kind of stuff, which is incredible, and unbelievable stability. We've basically had no downtime since 2017. So it's a stable platform, it's lightning fast, and it gets right to the point. It's a no bullshit platform. So I pulled up Google, and for those of you that are technicians that just want to see, one of the reasons I like Google a little bit is because here's the last move in Google. It's been beaten up, and this is we've had a pretty decent start to the year, and Google's gotten a little ugly. So That's just, I mean, and I know you're going to say, well, what about ChatGPT? And, you know, it doesn't have reason to be ugly and all this kind of stuff. I don't, like, again, I don't care about that stuff. I just look around and say, hey, you know what? It's ugly. Does it have decent IV? Well, one of the cool things about Tasty is we put IV rank right up here, which is measuring implied volatility for the last 52 weeks from 0 to 100. This is currently at 25.8. It's a little low. We'd like it to be over 30. This is not the implied volatility. The implied volatility in Google is over here. In April right now, it's about 36. It's about 36 or so. So the IV rank says that this 36% volatility in Google is ranked at 25 on a scale of 1 to 100. Anything over 30 is pretty decent. Does Google have decent volatility? I'm not sorry, decent volume. Is it liquid? And the answer is of course. Traded 36 million shares on Friday. Of course, it's a liquid underlying. And so, you know, so that's kind of, for starters, some of the stuff that I look at. Now, what I wanted to do today, again, was to say, how would somebody use the option market to facilitate or execute on their assumption? Like, let's just say, you know, hey, okay, I got a hunch. I don't want to bet a bunch. I just want to bet a small amount of money and on my assumption, but I want to do it in the most strategically optimal way. I want to do it. I want to be smart. You know what? I don't want to make the mistake that a lot of individual investors make. I want to basically trade this like I was a pro. Okay. And again, you don't know what's going to happen. And sometimes the stock wins and the stock doesn't accommodate. Sometimes the stock accommodates. Sometimes the stock doesn't accommodate. And so we like to say sometimes the stock wins, but all things being equal, and you know, and if you believe in random markets, you know, at least 50% of the time you're going to be right too, which is cool. So the first thing we do is we go to April, because I like to go closest to about 45 days. I know there's been massive growth in zero DTE options, and it's fine to look at them and play around, and they're good engagement tools and things like that. But if you want to talk about, you know, optimizing your option strategy in a reasonable decay curve, you want to be closest to 45 days. March is at 20 days right now. These are calendar days, not trading days. And April's 55. So April gets the nod for being closest to 45 days. Now, we don't care about the implied volatility over here because we already know where it ranks. But what we do care is the expected move. And the expected move in Google, as you can see right here, is plus or minus $6. Now that plus or minus $6 is based on option prices. So the most important thing about understanding about because people use the term volatility and they use it indiscriminately and they talk about volatility, you know, and sometimes I wonder if people really understand what volatility is. All volatility is, it's a measure of expected move. It's a variable inside the Black-Scholes model. And it's just, all it gives you is expected move. So what's the expected move for the next 55 days in Google? And the answer is, it's $6. Okay, now why is that relevant? Because if you're setting up an option strategy, you want the optimal duration, which in this case is 45 days. So I'm picking 55 because it's closest. I'm not going to use the weeklies. And you could, but I'm just not going to. And you want to know what the expected move is, because ideally, if you want, and by the way, that expected move, that is essentially, you know, that's representing about a 70% probability of being accurate, which is about as close as we can get. So that's just where it falls inside the distribution curve. And so that's what that is. But it's the most accurate representation of expected move that you can find. So that's $6 expected move. April. See, all of this stuff starts to help me out, because now I look at the stock and it closed at $89, let's just say. Okay. I know it traded a little bit higher in the aftermarket, but let's just say, oh no, it didn't. I'm sorry, take that back. It closed at $89. So if I know that I'm going out to April and I know that the expected move is $6 and I know that I want to get long with a certain strategy, then already in my head, I know I'm going to be looking right around the Google, somewhere around the 82.5 strike on the put side, or the 80 puts. They might only have $5 wide puts. Let's take a look. So we open up Google and they do only have $5 wide puts. Let me just change this for a second. We'll go to 20 strikes. So a couple of beautiful things about Tasty. First of all, this line in the middle represents where the stock is right now. So that line represents $89. And this first dotted line represents a 1 standard deviation move based on option prices. This second dotted line represents a 2 standard deviation move. So this first dotted line basically says that there's about a 16 or so % chance that we get to that first dotted line. That second dotted line means that there's about a 5% chance that gets that line. Same thing on the call side over here. Same, the same thing. 16% chance you get here, 5% chance you get here. This is where the current strike is. We already know, okay? We already know based on just the expected move that we're talking about. And by the way, I was, when I looked at Google a second ago, I'm sorry, I hadn't updated my screen. When I looked at Google before, I said $6. It's actually $7.41. That is the expected move in Google in April. I was looking at the wrong underline. So when I look at Google and I look at this, I'm saying, okay, well, the 80 puts are the perfect distance out of the money. So they're just outside of, the $7.41, which is the expected move. They're just outside of that. And so, so that would be the perfect strike. See how I did that? It's so simple. I just went out to the 45 days. First, I made sure the IV rank was high enough. Second, I made sure the volume was high enough. Third, I made sure that I moved my short strike, and I'm going to click on the bid. So I made sure my short strike was just outside of the expected move. And as you can see, these traded 1,800 contracts on Friday. It's a totally liquid option. It's 2 pennies wide, 144 to 146. Now let's talk about all the different things we could potentially do. Now this is where you, as an active trader, this is where your kind of know-how comes into play. If you do the same thing every time with every trade that you make, and you're not strategically diversified, you are hurting your chances of long-term success and survivability, because to be a very successful trader and an active trader, you need to be indifferent to product, and you need to be indifferent to strategy. You have to be agnostic. You can't think of things in terms of, hey, I only do this strategy, I only trade these products, I only trade stocks, or I only trade options, or I only trade futures. And by the way, on Tasty, you can trade anything you want. You can trade stocks, options, futures options, crypto, and you can trade them all in any type of account. We don't even have any restrictions. So you can do any strategy in any type of account that we have using any product. That's one of the coolest things about Tasty, in addition to the speed and the stability. But you now see I'm on the 80 strike. And in this case, it's liquid. I've moved outside of the expected move, and I'm a little bit bullish in Google. So the first thing, and a very simple trade, is, hey, you know what? I could just sell the puts naked. Now, just to give you an idea of like how, when you start to think about like, okay, well, if I sold the puts naked, is that capital efficient? Well, it's more capital efficient than buying the stock, obviously, because you only put up about 16 or 17% of the strike price. So it's way more capital efficient than buying the stock. But what if you have a small account? What if you're trying to allocate a certain amount of capital towards each trade you make? You don't want to go over a certain level. And this one, obviously the expectations for this, and let's talk about it for a little bit, the expectations on this trade. And I put this in here, just, I have a bunch of positions on in Google, so I don't want to like, there's a reason why all the numbers look a little bit weirder in here, because for me, I have a bunch of stuff on already. But like I look at things and say, hey, this is a cool feature we have on Tasty, which is called P50, which is the Monte Carlo simulation for what are the chances of making 50% of max profit. 50% of, let's call it $1.44, 72 and a half, or $1.45, 72 and a half cents. That's not a subjective number. That's actually, like, we call that quantitative finance. And, that's the chances of making it. Now you're taking unlimited risk to make 72 cents, but that's at least putting some context around that. The other thing that's interesting on Tasty is that we convert everything to SPY deltas. So if you sold in this case, okay, I'm going to change my quantity. Let me just move this Zoom stuff away. I'm going to change my quantity to one contract of this. So you see, this is the Google put. I have one contract here. And what's interesting about this is the one contract in Google terms is the equivalent of being long 20 shares of Google. But the one contract in SPY terms, like if we beta weighted it and converted it to SPY, which is a more kind of apples to apples type thing, it's only 5 shares of SPY, which I think everybody on this call is totally comfortable with. So anyway, that's a very simple way of just saying, hey, you know what? I want to get long Google. What is the highest probability trade with this has an 80+% theoretical probability. It has a 90% chance. And when I say 80% plus theoretical probabilities, because the delta is 20, and it's the inverse of the delta in 100, which gives you your probability of success in the trade. So your POP is 80. That's probability of profit. Your P50, which is your probability of making 50%, is 90. And obviously this trade is liquid and manageable and everything else, and it's only the equivalent of 20 shares of Google or 5 shares of Spiders. But okay, let's say you have a smaller account, or let's say you just don't care about Google that much. So what are some of the other things you can do? Now, here's where Tasty gets really cool. I can keep this short put, but on top of that, I can say, you know what? I'm going to sell a 100-105 call spread. Now, that's what we call a Jade Lizard, right? That's a short put combined with a short call spread. That's a term 2 of the women on our network came up with, but it's now become a very popular strategy, and it's a short put, short out of the money call spread. What this does is it adds another element of potentially some upside risk, but it also increases the credit because you go from $1.45 to $2.07. Okay, so that's another way. It changes, obviously reduces your risk because you go from 20 shares of Google down to 11. But that's how flexible this platform is. And the other cool thing about the platform is you never have to type in anything. If you wanted to move the call spread higher, you just drag it. So you could go up to the 105, 110. Okay, that keeps your probability of profit virtually, moves your probability of profit way up to 92%. It moves your P50, leaves your P50 as the same, just around 90%, and it reduces your long delta by 5 instead of by 10. Okay, these are all different things. Like if you wanted more safety to the downside because you weren't totally positive, you can move the call strike down. I'm sorry, you can move the put strike down from 80 to 75. All those are options. Like the coolest thing about this platform is we don't care what you do. In fact, even if you want to leave the 80 puts but sell twice as many of the 05, 10 call spreads, you could do that as well. You just highlight and then you just raise the quantity, and then you're short 1 put and 2 call spreads. And that's what this platform does. It doesn't care what you do. Now, here's the other cool thing. So let's go back to the original thought. We're going to sell the 100, 105, and then we're going to sell the 80 puts naked. It's still a long position. Okay, but let's just say you said, hey, you know what? I don't want to have any naked exposure to the downside. So you go out and you can say, okay, well, I'll buy the 75 puts. Now you have an iron condor on. Okay, now you say to yourself, okay, that's cool, but now I don't have enough delta because now you see my delta here, it's 0. So with 0 delta, I want it to be long Google. So maybe I should widen this put side out. Now you have a skewed iron condor. So I went from a short put to a Jade Lizard to an iron condor to a skewed iron condor. All right. And these are all things you could do. Now, if you're like, okay, yeah, but I'm only at 8 deltas. So, okay, you want more deltas? Add another put spread to it. Now you're short 2 wider put spreads and 1 call spread. Now you're back up to 24 deltas. And let's say, you know what? Let's say you're one of the people on here that you're like, hey, you know what? That's cool. I love the flexibility of this, but I have plenty of capital. Okay. I don't need to kind of, first of all, I'm happy selling the naked put, but you do know that if you sell a call with a put, your statistical chance of success, even though your pop goes down a little bit, your credit goes up. And historically, because we actually don't know what's going to happen, you end up making more money. So what if I did this and just sold an out of the money call? I'll go up to here and sell the 105s, but And let's just say I did the short strangle, but I sold a $2.87 put and a 105 call. Is there anything wrong with this? No, there's nothing wrong with it. It's just a much more bullish position because you almost tripled your long deltas. And I like being outside of the expected range. But this is a short strangle. These are all bullish positions. Again, let me start. Let me do this for a second because this is kind of this. I'll go take you through the whole progression. And again, like I do this for hours on end. So this is not something new. I'm bullish in Google. It meets all the requirements. It has high implied volatility. It has really good liquidity. We know the expected move is $7.41. Stock closed at 89. $7 minus 89 takes you down to 750 minus 89 takes you down to 81.5. Go right outside of that, it takes you to the 80 puts. So we click on the bid and we're selling those. The first thing we do is we could sell a naked put if we have plenty of capital and we like the high probability of success. If we want to make this into a short strangle, we will then sell the 105 calls. If we say, okay, this is a skewed strangle, still long 15 deltas, and the naked put was long 20, this is long 15, okay, it's something. But now we buy this call and we turn it into a jade lizard, so we really have no upside risk in case the stock explodes. Now, instead of, because we don't want just the naked put and the exposure there and the extra capital, we buy the out of the money put here and turn it into a skewed iron condor. These are all just combinations of different trades starting with a simple short put. And it's one of the coolest ways to show you how flexible option trading is and how flexible derivatives can be, especially in an era where nowadays you just have, the technology is so incredible. But let's say, because I don't want to run out of time here, let's just say, hey, you know what? This is all cool, but I'm going to go over and show you something, because another underlying that has been really beaten up, and again, this is one of the cool things about Tasty, another underlying that's been really beaten up is the Japanese yen. So here's the Japanese yen. And before you go, how do I trade Japanese yen? Well, this is a futures product. And the cool thing about Tasty is stock, options, futures, options, everything trades the exact same way, everything from the same interface. You don't even have to ever leave the page. And look at the Japanese yen, it's even uglier than Google as far as just like looking at all the selling pressure that's happened for the last month in there, or a little bit over that. The dollar had a monster sell-off to start the year, and then it's had a monster rally against, all these currencies, especially the Japanese yen. So if we said, hey, you know what? I'm thinking I like the same kind of setup here. The cool thing about the platform is, hey, we're going to go closest to 45 days. That takes us to April. Is there plenty of liquidity? Sure there is. There's tons of Japanese yen trade futures. We're going to open up the April options. They're not as liquid as, for example, Google options, but the logic's the same. I go to the same, let's call it the 72 puts here, all right, which are the 18 delta instead of the 20 delta. This gives me an 82% probability of profit by selling this naked put. Now, it's a little bit different game. It requires, obviously a little bit more capital because these contracts are a little bigger, but it's the same logic. The same low volatility in here. Everything looks the same. We go out to, just outside, right at the expected move. And again, everything stays the same. So if you wanted to go up here and sell, and, if you wanted to go up here and sell an out of the money call, or move the out of the money call way up here, let's see, way up here, you could. If you wanted to turn this into a jade lizard, you do that. If you wanted to turn this into an iron condor, you do that. See when you build really smart technology, every product looks the exact same. This allows individual investors to be indifferent to what they're trading, both strategy and product. Do you know that when you diversify strategy and you diversify product, you take almost 50% of your portfolio risk off the table? You have to do three things. A, you have to diversify underlying product. When I say diversify, it doesn't mean like buy S&Ps, buy NASDAQ. That's not diversification. I'm talking about non-correlated products. If you trade the Japanese yen versus Google, there's virtually zero correlation between those two. So they move independently. So they don't carry the same risk. If you change your strategy, so in one case, you use a defined risk trade like an iron condor, and in the other case, you use a naked strangle, okay, that takes another 30% off. And then if you manage the trade, remember, we're doing this trade at 40 days. If you manage this trade at 21 days, you basically eliminate your tail risk. What's the big thing? You know, when anybody talks about trading, what's the thing that scares the crap out of everybody? It's tail risk. It's what happens for those moves that you can't quantify. What happens when something happens that's not supposed to happen, right? That's the scariest thing. And there's no way to protect yourself. Forget stop orders, forget, you know, watching the tape, all that kind of stuff. The only way you can protect yourself, you know, and this is, it's actually quite simple, is stay small and manage early. That's the key to staying alive and staying afloat. I've been doing this for a long time. If you manage early and you stay small, you do whatever you want. Then, you know, that takes the tail risk out of the equation. Now you want to reduce your risk. So you reduce your risk by all the things we talked about: diversifying strategy, diversifying underlying, and if you could even diversify duration and volatilities, if you have that opportunity to, that's great. So I gave you kind of like I whet your appetite. I gave you like the literally the Reader's Digest version of what we do every day on Tasty, and you know what we do at our live events, and I really appreciate, Ken, the opportunity to come on here and you know spend 30 minutes with you guys, and it's just awesome, and thanks so much.
Well, Tom, I wanted to say thanks. It's a real honor to listen to. You're the number one person in the whole industry that I respect and learn from. You are the number one. So thank you, first of all, for that. Let me ask you this. You're exactly right. I say exits are more important than entries, and the math is a lot more important than the chart patterns. And I'm migrating over to you guys. I just put my application to get an account started with you guys.
It's awesome. Thank you so much.
But let me ask you this. Riddle me this. I always like to ask one smart question. Can you please advise the traders of the importance of, it's not chart patterns, it's sequencing, it's the delta, it's looking at the volatility. The math is a lot. And you said repeatedly, professional traders don't even hardly use charts. And that's completely opposite to what the whole freaking industry is teaching people: chart patterns. It's all about the math. Can you please, for the love of Pete, teach just briefly, I know we're out of time here, but just briefly, how can you communicate to these people the importance of, like what you did? You weren't looking at chart patterns, looking at math. People's eyes glaze over, but it's the correct way to trade. How can we migrate them to a more quantitative approach?
I'm glad you brought that up. It's really difficult, to change the way people have been taught, the way people think. But, we've done it with literally millions of people. Like I said, we've spent tens of millions of dollars building think tanks and research and writing books on just using. You have to recognize, if you don't believe markets are efficient, then it's very difficult to buy in to financial math, and it's hard to reverse engineer. I find it amazing, and I understand why it happens this way. Why over decades and decades, we never had the technology available, we never had the content available, we never had the products available, everything. We never had high frequency, market making, all this stuff. But the reality of finance is, it's efficient down to the fraction of the penny. There can't be, nobody can know. The marketplace is too big. So, but if you can't accept that, if you still think people know, then it's very difficult. And then you still think that there's something to patterns and something to, something much more than, randomness, or you believe in trends and things like that. And certainly, things look like markets are emotional. And markets get oversold and they get overbought, and you can back into different views of things. We've just spent an entire career, building a lot of financial wealth around using quantitative, let's call it quantitative statistics, probabilistic analysis, and just using the math based off of derivatives. We've basically backed into various variables in different pricing models, in Black-Scholes and everything else, to come up with essentially, we think are reasonable mechanics. Like, I can't convince somebody that something's not a double top, or something's not, sitting on support or whatever. I'm totally fine with looking at charts for engagement purposes and for getting excited about things. But the reality of trading, scalability, longevity, and everything else is really understanding the efficiency of markets and how do you play inside that efficient game.
All right, well said. Yeah, appreciate it. It's a real honor to have you here, man. I could listen to you for a whole week. I mean, you're brilliant.
Sorry, dog's barking.
Yeah, thanks so much, and highly recommend Tom Sosnoff and the team at Tasty. Best in class out there, and you are the best in class. There's nobody that even comes close. You're in a class of your own, man. So respect, and I know we're over time. So thanks so much for being here. Appreciate you. Always got an open door here, man. Anytime you want to present. So thanks.
Thanks so much, Ken, and thank you everybody for listening. Thanks, you appreciate it.
All right, thanks, man. Appreciate it.
Take care. Have a great weekend.
Hey, you too, man. Have a good one. All right. Well, hello. I'm going to switch over. Toni is out there. Toni, are you here? We can go over 5 minutes, whatever, to give you your full time. So don't worry about that. Let's see, where are you? Can
I
you
am here, Ken? Do you hear me?
Yeah, I do. Yeah. Hey, it's Toni
Hey.
Hansen, folks. And that was a real nice presentation from Tom and Larry, and I'm sure yours will be great too. It's a real honor to have all these smart people here. I learned from all you guys. Toni, can you take control? I think you can just click on share screen and you should be good to go.
Yeah, here, let me try again. It says host disabled screen sharing. Let me see if I can get that going.
Yeah. Thanks. And this is the first time I've had you here, so appreciate you for showing up. And
Yeah.
again, we'll run over. You'll get 5 minutes past the hour, so you get your full 30, and same for all the speakers. So,
Okay.
let me see them.
Yeah, it looks like you have screen sharing disabled though, so I'm not sure.
Okay,
It
let's
says
see.
host disabled,
Let's see,
participant
panelist.
screen sharing.
Let me see if I can find. Let's see. Are you in the? Let's see, in the list. You should be a co-host. Do you see yourself as a co-host? Let me see.
I am in presenters.
Okay, let me share my screen first, and then I will try and switch over to you, and hopefully we'll get this all taken care of. I apologize, folks, for the technology glitches here. Let's see. Okay, so can you? Okay, there you go. Let's see. Let me see if I can. I'll make you a co-host. Okay, so now I've enabled you as co-host. We'll
All
get
right.
there.
Cool.
And then now you should be able to, there should be a green share button. I'm
Yep,
trying to remember
you're good now.
Yeah, we're good. Okay. And thanks to Larry for telling me that's how it works. So appreciate it. Hey, that's good. Very professional. So, hey, folks, welcome to Toni Hansen from www.tonihansen.com. She's been in the industry for a long time, and I've wanted to work with her for a lot of years. So it's great to have her here.
Yeah, Ken, we've known each other for quite a long time, haven't we?
Yeah, we have. Yeah. I remember talking it was like 12 years ago, 15 years ago. Anyway, so take it away, Toni Hansen, and thanks for being here. Appreciate it.
Yeah, hey gang. So I've been trading here for about 25 years. Really when, the industry kind of first was transitioning onto online trading. And I do have a different approach than Tom. I'm not an options trader, you guys. I started out as a stock trader, swing trading, and transitioned into futures and Forex. And now I just kind of, do a little bit of everything. There's really a lot of different ways that you're going to see professional long-term traders trade. And some of us have a lot more technical approach than folks like Tom that are, relying on more of the mathematical equations. I focus upon reading traders' emotions through the charts. So very different approach here. It has worked for me really well over the last 25 years. And I'm going to share with you one of the strategies that I trade. Now, the thing here is though, when you're looking at technical analysis and you're looking at how can I read the market just based upon the charts? If you're thinking in terms of things like, hey, this is a double top, you're immediately going to be in a lot of trouble, because anything retesting a prior high or retesting a prior low could be considered like a double top or a double bottom until it proves to you that it's failed or worked. So when you're looking at just kind of basic things like that you're going to find like throughout the YouTube universe and basically everywhere out there. I mean, if you go and you Google something like head and shoulder strategy, right? Well, this is like one of the core technical patterns that a lot of traders are told about when they're coming into the markets. Problem with something like that is if you go and Google that and you try to apply what you come across on like those first half a dozen or dozen sort of quote unquote tutorials, you're going to be in a lot of trouble, because pattern analysis comes down to a lot of the mathematics. For me, I use things like Fibonacci, and I look at time development and momentum. And there's a lot of indicators and tools that you can use for adding momentum, but I do read pure price action, which is something that you will come across a lot of longer term traders do. We get a feel for the market in terms of how the momentum is playing out and how long it's taking for things to develop. And those are things that you can quantify. So from the technical side of things, what I'm going to share with you is a strategy that has a lot of those quantitatively in a way where it kind of whets your appetite in terms of starting to recognize some of the key traits that we look for and how can we improve upon them. Now, one of the things that I like to say about the markets is that when you're reading things like strategies, there's going to be traits that are going to improve your percentage of accuracy. There's going to be traits that improve your not just percentage, but your probability of accuracy and the probability of what sort of target levels are you going to be able to get to. Are you going to be able to get into something that's starting a brand new trend, or is this something that is, you know, with a possibility of going for a continuation, but your probability might only be 80%, and it's not going to be a full brand new trend type of move. So what I'm going to share with you guys here today, guys and gals, I should say, is a strategy that I have taught really for about 20 years or so, and it's called the Avalanche. So you're going to see a lot of valuations in here. This is the core template that I use for this. And throughout today's presentation, I'm going to share some of the examples of the ones that I've traded throughout the last couple of days and what we look for within them. So you could basically just do a screenshot of this, and this is going to show you the basics of what I am watching for. And let me grab a pen here. Get a nice blue color going. So this is what the avalanche looks like. And what we're starting with over here is a zone of congestion in the market where you're getting a lot of back and forth action, or we have a bigger trend that has been in play on the upside. And we're starting to get that trend channel now breaking. So we're getting momentum beginning to get to exhaustion levels. And I'll share with you some examples of this that we've traded here this week as we go forward. But I want to just kind of familiarize yourself with what this looks like. So there's a couple of different ways that people will look at charts. They'll look at the time frame charts and they'll look at tick charts. So a time frame chart would be something like a 5-minute time frame or a daily time frame. A tick chart would be something like the 80,000 tick chart or a 5,000 tick chart. And what we're looking at, what I kind of gravitate towards is that in the morning, I use a lot more of the time frame charts. And as the day progresses, I kind of switch on over to using more of the tick charts. So the characteristics and traits on here are going to apply to both of them. And really what we're doing is we're building something. We are looking at individual characteristics that are going into pattern developments, not something as kind of just what would I don't know what the word is I'm thinking of, but just kind of like as esoteric, like a head and shoulders. We're going to look at the traits that go into that. So in an avalanche, this could be the right shoulder in a head and shoulders. It could be the handle of what people would refer to as cup with handles. But what we're looking at are the traits that go into the development of that portion. So the first thing we want to look for is something that is breaking out of that channel over here. And we're getting momentum on the downside that is average to slightly stronger than average. And again, you can use quantitative formulas for, hey, what is the average momentum in a chart? Just looking basics, if you get like V's and back and forth V's, you know, that's a really easy way to just kind of judge, hey, what's normal in this particular security. And what we then want to look for is something where we get a two-wave movement, and then we go into a corrective period. And within that corrective period, the core avalanche is going to base out for twice as long as that initial pullback is going to be. So we have Y equaling Z here. Now, within that portion Z, we want to look at two corrections within that point. Now in here, we can break down this formula even further. We can look at where within these two-wave corrections are we seeing the pivot highs forming. So for our core template, where we have a probability of 90% or more that it is going to put in a measured move on the downside compared to Y as it's coming out of Z, what we want to see is a pivot high in A, where that pivot is at the 50% point or later. So it's usually going to be between 50 to 61.8%. And the point that is even more important is over here in B. In this portion, what we want to see is that that second pivot high there, we'll label these pivots here 1 and 2. What we want to see with 2 is that it has a pivot that is at 61.8% or more of the price and time extension, the time extension really, of A. So what we want to see is that pivot that is in that kind of last, really that last third zone, where we have it basically doing about 2/3 of A for a pivot high in there. Now, one of the other traits that we can use to improve our success on this particular pattern is to use a Fibonacci fan. And so Fibonacci time extensions work great for giving us an idea of the development here from Y to Z and even A to B. But your Fibonacci fans, we're going to get more specific. So what we want to do here, what I want to do when I'm trading this is I want that 61.8% Fib fan level to hook up with this initial pivot high here. So at that point, it's usually going to be taking your fan level from this high to this low, but sometimes there's going to be the need to make adjustments. And I'm going to show you that in one of my trades here from the last 2 days. And when that is hooking up with our 61.8, and again, this is your core strategy here. I do have a number of variations of this that again also have these quantitative rules to it. But what I'm looking for next is that the second high here is going to be at that 76.4% zone to 78.2% zone. So I'm looking at that correction in here. And within this, ideally, we are going to stay in the bottom portion of this pullback as long as this momentum is average. If the momentum is slower, some of the traits are going to begin to shift. The Z portion can become smaller and the Y portion can become larger with momentum being a little bit more gradual on the downside. But for our core template, this is what I want you guys to really be focusing upon. Now we can also look at measure for this strategy. And what we want to see is the highest kind of accumulation of volume happening right in here between Y and Z. Then we want volume to be declining here during A. We have a little bit of a spike here as we're going into B, but not as much overall accumulation of volume as we do coming into the start of A. And then we have our lightest volume as that is coming up into our pivot high up here. So these are kind of the main traits that we're going to be looking for within this particular strategy. And let me show you what we have here as this continues to unfold. So here's an example. This is the very last trade that I took as I was heading into the weekend here. And this version of an Avalanche is one that is tilted. What you can see here, though, is that we have almost all of those kind of core traits at play. We have the channel break up here. We've got that increase in momentum with a two-wave movement coming off of that high. Now, what you'll notice though is that this move here, as we're heading into the last hour of trading, is stronger than average, and it's even stronger than what we're seeing as this upside move here, where there's very little overlap in our prices on the 200 tick chart. So when that happens, a lot of times our congestion can double out so that we end up with twice Z for that. But what we wanted to watch for were the corrections in here. You'll notice we've got that pivot high at that 50%. Came on down here. We've got a secondary move here where we've got a two-wave move up, but this pivot high is a little bit before that 61.8%. So in order to get that strong downside coming into play, I needed to see this do a double high, or you could get a smaller head and shoulders pattern with a smaller avalanche here where that pivot high is at that 50%. But getting that retest of that previous high zone here after that 61.8%, that's telling me that, hey, you know what? We've got our channels with the slower corrective moves here than we saw on the downside move. And so what I needed to see as far as confirmation goes is that I needed to see this break the lower end of this channel here as we're coming out of that 100% time extension right here between the two lows. So this is A and this is B. So my entry point on this, I used it as it was pivoting off of after that 61.8. And my stop level on this becomes simply taking that trading channel down and moving it lower. And when I'm hooking up the 61.8% fan with this is going to become my 76.4% fib fan. And so I'm going to just trail this down here to begin with. And what that does is that I've got a pattern that really early on, I'm not going to be taking a full stop on, even if it ends up not working out. 1500 is also a really good pivot time in the market when you're heading into that last hour of the day. So we often see a lot of new trend moves really kicking off at that particular time frame there. Here's a chart that shows you the adjustment that I made with that fib fan. So you can see that I hooked up the 61.8% fib fan with that first pivot high in there. And we know that is the first pivot high because we have a move here where as this is trying to come down and move lower, it doesn't have the strength that the move does over here. So as this comes back in, I need to see a corrective move that's going to last about that same amount of time as that first correction did. And as long as I can get that comparable time development there, then I have a really high probability of this working out and continuing on the downside. The avalanche in here is actually part of a megaphone that continued this move in here. So my trigger point was right here. It was just over about half an hour before we were heading into the end of the day there. Now, another one of the trades that I had here was in gold. And this was a continuation of a reversal that had triggered earlier in the day. And we can see the momentum changing here, where we've got that kind of nice strong upside move. You can see the V bottom here. So pretty average momentum starts to shift up here. We actually get a really small avalanche right here. And this is one of my favorite core strategies, where we get the 3 highs and then we get our avalanche with the channel break. That's one of my very favorite strategies that I look for. And again, there's quantitative measures that we can apply to that particular strategy as well. And what I was looking for was for the continuation, is that we had that same kind of momentum coming down here as we saw with that V. So I wanted to see something that would shift and change momentum and go into more of this consolidative type of move with, again, ideally those 2 corrective highs in here. So let me shift this on over and show you as this is continuing to expand here. So with volume, what you'll notice is that this is where we have that pattern happening. Now, we are looking at post-market and pre-market volume here as well. So it becomes a little bit trickier than when you were looking at the smaller little avalanche that took place right here, where we've got, really nice light volume. But overall, this volume compared to when we were breaking down over here is a lot weaker. So we're getting the more of that congestive type of movement coming into play. Now, here is our time development on this. So what I was using was, I wanted to see something that was going to offer me, again, that continuation in here. And I wasn't in time earlier to catch the pivot high here. But what you'll notice is that as we go and put that time extension between those lows, the first pivot here is earlier than what we would ideally like to see. So I needed to get something where that second corrective move would put in a high that is at or after the 61.8% of the time extension here. And that's that blue line right here. And in this case, when I hook up a 61.8% here with my fib fans, I've got my 76.4% coming in here. So technically the trigger is right here for the short side. But when I came in, I was looking at the overall momentum here compared to what we were seeing back and forth. And it was still very, very strong momentum. So what I wanted to see was something that could shift and change that momentum. Now, on the continuation, what we want to get is I need to see this breaking that channel as it's coming into no later than the 138.2% fib time extension here, meaning from here to here. I need to see this showing selling coming into there. So what I ended up using was starting to build into a position as it was breaking that 200% zone, and we had that additional little correction in here, because that is that smaller shoulder or avalanche that was forming on the intraday timeframes, on the much smaller timeframes. And then I just built into the position. Typical target levels on this, if the momentum coming out of the avalanche has the same rate of change, which again, there's different momentum indicators that you can use out there, as long as that has that, or you can just visualize it like I do. As long as it has that same rate of change in there, we're going to be looking for 100% extension. Now, if it starts to pick up momentum or it's breaking a larger channel on a bigger time frame, that trend can continue. Examples of where we would look for a continuation of that trend would be to take our time development of our avalanche and look for that same time extension. And that is going to give us the do or die point for the continuation strategies. Now, I know that 30 minutes is a really short period of time here for you guys to start to learn a brand new strategy. And then you've got to go and add on things like, hey, do I want to trade this with options, or I'm going to trade this with pure futures or stock contracts or shares in here. But the more you go and study that template, the more you're going to start to see how well this works for these larger trend continuations that are kind of just beginning. This is a particular type of avalanche in here, but the one that is easier for traders to pick up on is looking at where you've got, again, that shoulder for a head and shoulder strategy, where in this case, we have kind of this double bottom in the middle. So when we're looking at our time extension, we're just splitting that in half again. And we'll get our 61.8% here. So if you want to focus on looking at, hey, how do we take some of these core technical trading strategies and look at specific rules for them, there's definitely a way to do that. And this is really one of the core ones that I look at. This was an avalanche that was triggering as I was heading into, I teach online at noon every single day. I do live market analysis and education. And this was an avalanche again that we had during our noon strategy on yesterday. And again, it's that same type of pattern. And as we were heading into the end of the session, this is where I called the target level on it. So these are things that we're doing live, and you're really able to get that better confidence in seeing it playing out and really fulfilling itself in the live markets. So for you guys that want to learn a little bit more about how I combine the technical analysis with more of what we think of in terms of like an engineering or mathematical mindset, I'd like to invite you to join me for a 3-hour mentoring program that I'm having next Saturday. And it's just for $100. All of my proceeds go to my local charity here. I work with the local shelters, the shelter system for fosters. And so all of the profits from this are going to that endeavor. We actually have a big rescue operation here happening this weekend too within the city. Now, this strategy is going to show you how we look at these pivots and reversals and how we use them for timing exits. What sort of volatility factors do we use? What sort of things do we use in terms of volume and momentum? And how can we read these actual pivots, whether we're going to use them for reversal strategies or if we're going to use them for target levels? I do have some plugins, Guy, that we have on NinjaTrader, working on developing them for some of the other platforms out there. And this is where I did the exit on that strategy here as we were heading into the end of the day. And here's a execution. So you can see exactly how close we are to be able to get those absolute highs and lows using the specific triggers that I use. So I want to thank you all for joining me here today, and thank you, Ken. It's been a long time since I guess I can't say I've really seen you here, right? But it's definitely a while since we've talked. And so thanks again for having me, and I hope you guys enjoy the rest of what is coming here this afternoon.
Well, thanks very much, Toni, for your presentation. I really like the logic behind. You've got it's really important too that you have a well-developed process and a pattern that's recognizable and it's repeatable, and people can with time learn how to recognize it, and with your help. So a very intelligent, you got a smart approach here. So that's the first
Yeah,
time
I mean, it's not something where you're looking and you're trying to pull out, hey, like everybody can see what looks like a bull flag or a bear flag or head and shoulders after the fact, right?
right,
But
yeah.
how do you quantitative it?
And how do
How
you
you
identify it ahead of
quantify it?
time? Right.
Exactly, right.
Right. So
Going
good stuff.
into it.
So
Yeah, so
folks, go visit Toni's site at tonyhansen.com/wealth and get involved. She knows her stuff. A good lady to
yep.
learn from. So thanks,
And you
Toni.
can follow me along live there for a month
Yeah,
free as
that's
well. So
that's very generous. So
thank
the
you.
price is right. So hey, thanks, Toni. Appreciate it for you being here. It's a
Thanks again,
pleasure. Good
guys.
job.
Take care.
And thanks, you too. All right, traders, we are going to move on. We've got quite the event here. It's really a pleasure to have so many smart people in one place. Let me get this underway. We're going to turn over to Anka Metcalf, and we are running Metcalf. We're just a few minutes behind. We're running about 5 minutes behind, and that's fine. Each speaker can carry on from there. Let me get this in line, and let me show the time frame here. Anka, are you there?
Hello, Ken, and thank you for having me. Hello, everybody.
Yeah, thanks. And it's a real pleasure to have you here. You're another first timer here, and it's a real pleasure. You've got a really good reputation. That's why I invited you. And thank you so much for being here. Feel free to run, 10 minutes over. We're a little behind, so we'll just bump everyone's time forward by a bit. And a lot of good learning here from everybody. It's I always pick up new things from you folks. Let me first of all make you a co-host. And I just did that. And now you should be able to click on the green share button in the bar that's on your side, on your screen, and you should be good to go.
All right.
Hey, there you go. Okay, so everybody, and Anka has a really good reputation, by the way. That's why I invited her. What do you guys think? I like working with the best and the brightest because there's so much of the other kind out there. So, like on YouTube or in some of these other events, so we don't go there. We want people that actually bring value and can actually help traders. And so it's a real honor to have so many smart, wonderful people here. This is Anka Metcalf from www.tradeoutloud.com, and she has a really good reputation. So Anka, take it away, and feel free to run till the 30 minutes from now. Thanks,
Okay,
and
perfect.
thanks for being here. Yeah, thanks.
Okay, thank you so much, Ken, for having me. It's my first time here, and I really enjoyed Toni's presentation. As always, we kind of like go together in like all presentations where we have invites. So it was really nice to see her here. I truly love her, and you guys are just going to learn a lot from her as well. So all right, let's get this show on the road. I have 30 minutes, so let's make the most out of it, and I'm gonna run probably till like 2:37. It's 2:07 right now. All right, so today I'm going to be talking about the technical blueprint and how you can start generating income, because I'm going to be talking about day trading, and day trading is an income style of trading. Swing trading is a wealth generation as well as investing in the market. So it refers to higher time frames. So day trading is basically that a zip code where you hold the trade, let's say from a few minutes to a couple of hours or even a few hours, but until the market closes. You don't carry it overnight. Where swing trading, you can carry a position from 2 days to all the way to about 2 weeks, and investing goes from a really larger horizon. We're talking about Warren Buffett. All right, so today I'm going to be talking about generating income and generating above average profits. I'm going to share with you my personal portfolio. I'm going to share what we do at Trade Out Loud. And this is by trading only 2 hours a day. Now, for those of you that do not know me, well, it has not always been the case, because I have been trading stocks when I first started approaching day trading. I've been a swing trader for, I don't know, decades. But for day trading, I just started about 20 years ago. And I am never going to look back. I love what I'm doing, but it was definitely not for 2 hours. And I was spending more than 10 to 12 hours a day. And yes, I was there when the market would open. I would trade all throughout the day. And you get tired of it. And you don't have to do that. You don't have to repeat the mistakes that, other people have made. All right, so let's get started. My name is Anka Metcalf. I'm the CEO and founder of TradeOutloud.com, which is a trading education firm that is specialized in educating individuals how to day trade, swing trade, and invest in any kind of market and in any kind of market environment, in stocks and futures and forex and cryptos, whatever it is. I have been doing this professionally for over 20 years, and I do specialize in high velocity moves. So because I have been trading for so long, I have developed a system where I use technical analysis and market timing to my advantage, and I need to have at least 2 to 3 confluence zones before I pull the trigger. Now, I'm going to ask you guys really quick, how many of you guys have taken a trade, especially, and I'm addressing those of you guys that are day traders. How many of you guys have taken a trade? You saw the perfect opportunity. You saw the perfect setup. It was forming at a support level. It was above a moving average. Your RSI was indicating a buy. It got you in the trade. So you applied your risk for the trade. And when you look like 10 minutes into the trade suddenly turns around and it stops you out. Now, don't get me wrong, stop outs are very common, and these stop outs occur based on technical patterns, narrative, etc. But let me tell you something. The timing is everything, and I'm going to share with you today some of the biggest timing secrets. All right, so if there is anything that you're going to take away from this little mini workshop, if you will, 30 minutes of mine, is that I want to teach you these timings and how they work so you can apply them to your next trading session on Monday and Tuesday. It's not a really sophisticated strategy. It actually fits on a Post-it. Okay. All right. So I've also come with 10 years in investment banking. That really hasn't helped me a lot, unless, but it did help me it did help me in the sense of technical analysis and help me, evaluate stocks and so on and so forth. But for what I'm doing right now, no, it doesn't happen. In fact, I do have a lot of clients that are financial advisors, that are trading, that are working in the investment field. All right, so I teach a method that it is a proprietary trading method, but I'm the designer of it. I cannot take credit for something that I didn't invent, and that is technical analysis. Nobody can take credit for that, right? So I put a different spin on it because I was coached by one of the most brilliant brains on Wall Street. And my mentor taught me that, hey, there's so much more to price action than what meets the eye to be a successful trader. And you need to put your shoes into the institutional side in order to do that. And I have been trained by this individual, and I'm forever grateful. And I'm really happy to share with you. And I share every single day in my trading room that I run for day trading my experience in the market. But I'm looking for price support resistance. And you guys are going to say, hey, you know what? Price support resistance, everybody knows that you buy on support or you sell into resistance, right? Well, it's not really the case, because you need to see price evidence, and price evidence comes from candlestick formations. Yeah, candlesticks. It all goes back right to the beginning, where you pay attention to candlesticks. Red candlestick, green candlestick, where you can see on a green candlestick the buying pressure, and on a red candlestick the selling pressure, right? Because you're building up a green, 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 or red, red, red. Well, what if I told you that if you see a big fat juicy bar on any time frame, whatever your zip code is, whether you are a day trader, a swing trader, or an investor, so if you're seeing, let's say, on a 5-minute chart, you're a day trader, you were seeing that green candle on a 5-minute chart. If I told you that there is 90% chance that after that green candle has closed, for another green candle to pop up and continue higher. Yes. An object in motion tends to stay in motion, and this is what you need to stock for. You got to train your brain how to trade successfully, and it's not difficult. You got to go back to the basics. All right, so when I use price support resistance, I use confluence zones. For example, I use supply and demand just like everybody else, but I also look at a hybrid of Elliott waves. Well, I know it sounds really fancy, but it's not. is basically a higher low or lower high within the context of the pattern that you're trading. And if you have that, that will suggest that the pattern will have more odds to the upside or to the outside or to the downside if you have that present. I also have developed trigger times. I have noticed from day trading stocks that I have done for, like I said, over 20 years, that there are certain timings into the market where patterns seem to work better. If I use this confluence support resistance zones at specific times, I get a much better return on my investment. And also trade specific price zones. Guys, there are 4 specific price zones. We teach those in our course, and I need to take, some time in order to teach those to you right now. And now, because of the time constraint, I cannot do that. But for example, yes, I do have examples for that. We're going to get there. For specific price zones, we're going to get to charts in a second. So specific price zones are institutional, let's say, levels. They're not really levels, but they're institutional zones. Let's call them zones, areas. There's the same thing, tomato. However, these are the areas, and they're exact on every single chart. They're exact where institutions are legging in or legging out of trades. Okay. And that's super important because institutions cannot buy, like me, like 5 contracts of NASDAQ or, buy 2,000 shares of Apple. So they need to buy volume, and these are the levels where they scale in and scale out. And soon after we identify these levels, we get into the trade, and you're going to see that velocity that I have been talking about here happen. So it means that you're triggered, boom, right time, right pattern. The price moves either up or down, depending on whether you're long and short. And chart synchronicity. Chart synchronicity is so important. I know I went a little bit further in here to explain, but to understand a little bit about my background and how I trade, I really needed to emphasize on this. Chart synchronicity is so important because chart synchronicity and divergency is showing you what you need to trade every single day based upon what's trading, what is leading, and what is lagging. All right, without further ado, if you guys want to find out more about Trade Out and what we do, you can head on to our website. These are our social media pages, and our handle is easy. It is Trade Out Loud. Now, here's my agenda for today, and I'm going to really, really fast through these because we want to get through some charts. First of all, the basics of what you think you know, but you don't. How to pre-plan your trade before your trading session open, because like I said, I only trade from 9:30 till about 11 or 11:30. Most days I'm done around 10 o'clock or 10:15, and I'm done, literally done, shut the trading room down, and I'm walking away. How to select your trade. And we're going to talk about some criteria on how you need to select that trade, not only based on synchronicity and divergency. That is really not complicated at all. What time frames to focus on when you're trading the open, because this is the big debacle, right? Everybody's like, what is your favorite time frame? I don't trade the 1 minute from, for example, from the open all the way to 11:30, because the timing is different and the movement of action is different. The volume comes different into the market. So therefore, you need to apply a combination. Now the market becomes super fast. I have some charts in here that I'm going to show you, and some slides that are going to show you how you need to act between 9:30 and 10 o'clock, and from 10 o'clock to 10:30, and so on. And then we're going to talk a little bit about risk reward if we have time. If not, we're going to jump to charts. All right, so this presentation is for you guys that literally came up here, okay, and showed up on a Saturday afternoon, determined to learn how to trade. So guess what? So to make more money. My biggest thing to get into day trading was to get rid of my commute. My commute was taking about 3 hours, 3.5 hours every single day. And I was getting so tired of it. Now I trade less than I was commuting. So this presentation is for you guys that want to achieve above average gains. And guess what? You guys are here. You guys are going to achieve that. power trading the futures market. I wasn't always trading the futures market. However, I got into the futures market because I was making money day trading stocks and I was paying a lot of taxes. And for tax reasons, my accountant suggested and my advisor suggested that I move to the futures market if I still want to be that aggressive into the market. And I was really bummed at first, but then I gave it a second thought and say, hey, you know what? Before getting into any trade, into any stock trade, I was still analyzing the market. I was still analyzing the Qs, the SPYs, Russell and Diamond. So now basically I'm going to be trading the market, what's under the hood. But basically, I'm gonna stop scanning altogether. I'm gonna stop scanning for stocks. Don't get me wrong, I still trade stocks, but I swing trade stocks and I invest in stocks. So trading 4 charts, you guys think you could do that? Trading 4 charts, and by the way, you're only gonna be trading 1. You don't have to trade all 4, but these 4 charts are gonna be on your screen. That's it. No scanning, no homework, nothing. 2 hours a day. And again, I emphasize less because we do have, based upon where we are in earnings season, we have faster market and slower market. And yes, there are days when we can be done at 10 o'clock or even before that, trust me. And again, stress-free, everybody that, and if there is anybody in here that has been in my trading room, you guys know that I'm all for stress-free. I'm never stressed when I'm trading because I do not risk more than one allocated R, right? A risk unit. And I position size for that. That is the key right here. If you're looking for that holy grail, and by the way, holy grail doesn't exist and there's no such thing as a perfect trading system. However, if you're looking for that holy grail and say, hey, how can I achieve consistency? Look no further than not your strategy, not your trading style, not your time frame, but the risk that you're applying for each and every single trade. So why are we all here again? I want to hear from you guys. We love money. How many of you guys in here, give me a yes. How many of you guys in here love money? I'm here and I can tell you I love money. And I'm in here because I really love money, right? We would not be here if we would not love money. So you have to have a really good relationship with money, right? Think about this. Every single time when you push the buy button or when you push the sell button, you have to think, hey, do I love my money enough to risk it in this trade? Do I really want to risk in this trade? And you're going to see that, hey, you know what? This is not worth taking. That is loving your money. Yeah. And again, it gets you to that freedom, right? Well, you still have to do the homework. I mean, it's not complete freedom because you still have to trade, but yeah, it is financial freedom, right? It is financial freedom because we can make our money from the market, whether it's pandemic, whether we have, some kind of lockdown or recession, or, everybody's, kind of thinking depression or whatever it is into the market. Inflation, it definitely can supplement your income, can bring more money into it. And of course, you know what? I gotta say, it depends on the market environment as well, because some months are really ridiculously hard, like it was the case with February. Like January was the breeze. We also had earnings season to thank for that. And now we're like really slowing down. We're going to talk about that next. So we all want to make more money for different reasons, right? All right. But in reality, what is your account saying about you, right? So take a look at your account, do this exercise today and say, hey, what is my account telling about me? How did I perform in January? How am I performing in February? What is my account telling about last year's trading performance? And then you're going to find an answer and say, hey, maybe I'm not loving my money as much because maybe I want to, I don't know, maybe I want to go study a little bit more. You have a lot of free information out there, but like Ken was saying earlier, it's like, you find a lot of really bad intended people on Reddit, for example. There are some groups on Discords and YouTubes. They're not all 100%. Okay, so do your due diligence before you learn something that then you have to get rid of. Okay, all right. So I'm going to answer some questions. So feel free to post here in the room. I hope I have time. Fingers crossed. All right. So in order to make more money, you have to become a master trader. Why do do think we have to become a master trader, and you're not going to become a master trader from the first day. It needs time until you absorb all the material, and it's fine. I did not quit my job, started trading, and poof, in a week I was a master trader. No, it doesn't happen like that. In fact, my mentor, which Wall Street guy, he said, look, I know you're profitable. And I was trading small. I was trading really small. I was trading 100 shares. I think the max shares that I was trading at the beginning were like 500 shares when I started day trading. He said, you know what, even if you're consistent right now, look, it's going to take you about 3 years until you become really good at what you're doing. And I'm like, I've got this. Are you kidding me? No. And I realized that by each month that passed by, I was learning more, and I was learning more about the market. I was learning more about the context. I was learning more about earnings season. I was learning more about the whole structure of the market. And yes, I was trading in 2007. I was trading in 2008 and 2009. I was in the market in the year 2000, but I was on the swing side and the investor side back then. So I was in the market, and I was actually day trading very actively through the last recession that we had. And I helped a lot of traders pro bono. And in fact, the thing was that I created my company after the 2008, 2009. I created my company in 2010 because I was doing 2 years. I had done 2 years of pro bono work, helping everybody out, trying to, calm down everybody that, they were seeing their 401ks flying, their money flying away. So you need to strive to become a master trader, but you become a master trader in time. And you have to start from the beginning, start with some candlesticks, start with technical analysis. So start slow, but start from somewhere, and set yourself goals for every single week, right? And say, hey, this week, by Friday, I'm going to learn about, moving averages, let's say, and make it your goal. Because if you don't set your goal, and say, hey, I got to learn about technical analysis, or I got to learn about moving averages, and you don't have a time constraint, it's never going to be fulfilled. Create a goal creates urgency. So set yourself goals and say, okay, make a list. This week, I'm going to learn candlesticks. Next week, I'm going to learn moving averages. And the following, I'm going to learn whatever it is that you want to learn, whatever the system it is that you want to learn. So basically, it's about this becoming a master trader and becoming an astute trader, an educated trader. And remember, why do we need to be master traders? Because when you know whom you're up against, it's not a joke. We're trading against the brightest, most clever minds on Wall Street that have designed the most sophisticated algorithms that there are. And don't forget, 87% of the market volume is algorithmic trading. And I've heard somebody send me an email saying, no, it is actually 93%. It grew to 93%. I haven't verified that information yet, but it seems that 93%, even if 87 is a lot, is algorithmic trading. So that means that they have eliminated those small guys, going in and out, in and out. Basically, the day trading part is almost everything controlled by algorithms. So becoming a really good trader is basically creating confidence in yourself, right? Is creating, it teaches you how to become accurate, how to become disciplined, how to become patient, how to take control of things, how to become knowledgeable of things, right? Okay, so stress-free, happy, fulfilled, etc. I don't know, how much time do I have? It's 7:20 and I think I have till 37. Okay, so I have 10 more minutes. So you need to know when to trade and when to sit on your hands, because the environment is tough right now. And I'm talking about, this week it was very tough, and next week may be a little bit tougher as well, as we're heading into the end of the month with the balancing. You need to know how to trade, and you need to know how to handle any market condition, because trading is not only about that moving average that I told you guys about. It's a whole system. It is a rule-based system, because if it wasn't a rule-based system, these institutions trading institutions, financial institutions would not be able to program their algorithms, right? Finding highest trades, waiting for a setup, having the patience to wait for that setup. It's really very important. If you don't have patience to wait for a setup, I suggest move to a really higher time frame. Write this down. Move to a really higher time frame, like a 15-minute or a 5-minute, and set your clock from 5 to 5 minutes. And don't look at the chart. Just move around. Get up from your chair. Just move it around your office and then get back there. Fine and precise execution. You need to have that refined execution. You need to have really good management skills and how to literally learn how to trail your trade. So once you are in a trade, say, hey, when I achieve target 1, what do I do? When I achieve target 2, what do I do? Do I sell half? Do I sell a quarter? Do I hold the whole positions? You need to have a plan. And of course, patience. So we're all here because we want more money. We want to supplement our income. We want, to learn how it's done. Now, let me tell you about the time and efficiency with futures, right? Because this is what I do every single day from Monday to Friday from 9:30 till about 11:30. Now, I'm going to give you this example right here. I don't know how many of you guys in here, just swing trade or day trade stocks or futures, but regardless, if you're a stock trader, this information is key to you, and it's going to help you decide really quick whether you want to tap into the futures market. So here's the advantage of the futures trading. If a trader wants to buy the Qs, let's say they're priced at $300, you need about $16,000 in order to buy her shares. And of course, you need to have a $30,000 account. You know that. Because if you the normal requirement is 25K, but if you lose a penny, your day trading status out the door. And if the price goes up 50 cents, you make $50. We're in the futures market. Let's say you want to buy NASDAQ, right? Equivalent Q with NASDAQ. Let's say the price is trading at $15,000, right? The trader needs about $17,000. Well, you can see like approximate the same amount of money, 16, 17, to buy one contract. And if the price goes up 50 points, then you make $1,000 because each point is $20. Okay. All right. So let me show you an example real quick. This is a strategy. This is a trade actually that we took. I think it was on the 15th, right? So not too long ago, it was last week. And you can see it right here. This was the entry, right? You can see the arrow. This was the entry. We need to look for technical rotations with the trend. I trade with the trend. I do love to take counter trends as well. So I'm not only a trend trader, but I like to trade counter trends as well with confirmation. And I bought it with 100 shares. I made this example for a webinar that I've done. Buying power was close to 16,000. And you can see that I made about $303, right? Now, let me show you a different chart. This is NASDAQ futures, same thing. The buy was here. In fact, you can see that there is no difference in the chart pattern. The buy was still here. I bought one contract with the buying power of $17,000 and I made $2,400 in the same trade. So I'm going to ask you, do you guys want to trade stocks, make $300 with the same amount of money, or do you want to make $2,400? But wait, look at mini NASDAQ. Say, hey, I don't have a big account. I have only, let's say, a $10,000 account. What do? You trade micros, right? Micros all the tenth of the size of the full size contract. And as you can see here, the buying power effect is $1,700. Even with $1,700, those $1,700 can make you, okay, $246, where $15,000 is going to make you $300. Okay, did I make my point, guys? All right, but wait, there's more. This is the mini S&P. You're going to see the, this is the SPY, same buy setup that developed here, $265, $20,000 in buying power with 100 shares. And here we have the mini S&P futures contract, which with one contract, don't take a look at this because this was the trade that I carried on, so don't ignore this. All right, this is the P&L for the day, $3,600, and you can see it right here with $4,600. And wait, if you have a small account, let's say you have $5,000 account or $10,000 account with one micro contract, $127. So you can see the time efficiency and the power of the market. Okay. All right. So I'm going to skip through these because I'm going to go really quickly right here because I have like 5 more minutes left. And futures, the basics, and what I focus on. Timing. Timing is everything. Market timing. The market has a rhythm. It opens at 9:30. It shoots to 10 o'clock. Then it shoots to 9:30. Very fast-paced market from 9:30 to 10 o'clock. From 10 o'clock to 10:30 is kind of stabilized. And from 10:30, it either starts to trend, higher or lower, depending on what the market environment is. And how can we trade these? Well, we have the following time frames: 2, 5, 15. I'm going to show you a different slide and which time frames you need to trade. What do you focus on? This is a trading plan in one slide. Pull back buys or sells with confirmation of rotation at those confluent zones, breaks and breakdowns. Boom, the easiest patterns. Execution timeframes. I told you guys I'm going to share my personal execution timeframes. 9:35. When the market opens at 9:30, it does a move into the 9:35. From 9:35, I'm going to show you here. Okay, so when the market opens at 9:30, it shoots to 10 o'clock, right? Or it creates a sideways range. From 10 o'clock, it's reversal time. It's an official reversal time in the market. And what goes up must go down. If the pullback is shallow, take this buy, take this rotation. And again, here, trade it on a 5-minute. If you're trading here, 1 and 2 minute. If you're trading anything from 10:30, just move to the 5-minute. All right, preparation. You need to pay attention to economic releases, earnings. You need to form your own pre-market game plan. Multi-time frame analysis is a must. Determine your trigger point and locations, and the market is going to do the rest. We're here, week 7 of earnings season. Things are really slowing down. There are not going to be many companies that are going to impact the market. So it's all going to be narrative. Everything that is going to be on the news is going to influence the market. Here's what the time frames that you need to use. On the 1 minute, you use the 1 minute chart from 9:30 to 10 o'clock, the 2 minute chart from 9:30 to 10 o'clock, the 5 minute chart from 10 o'clock to 10:30, 15-minute chart from 11:30 to 2 o'clock. Don't have time for explanation now. 5-minute chart from 2 o'clock to 4 o'clock. Okay. And if you're trading the overnight market, focus on the 4-hour and the 1 hour, only the Asian session. And if you're trading London session, go back to the 5 and 15, forget about the 1 and 2. All right. So if you want to trade with me, we teach and trade live every single day. Highly successful technical system that trades in sync with the institutional money flow in the first 2 hours to enable us to make money on momentum moves, specific locations, etc. All right, so if you guys want to join my trading room, here's the link for the trading room. Go to tradeoutloud.com under services. I don't have it here for some reason. We take between 1 and 3 trades every single day. If there's not a good market environment, we don't take any trades. Okay, so I just want to show you really quickly right here. Okay, so when you sign up for the trading room, you're going to get access to the track performance. All the trades are being tracked here. You have access to the monthly performance. These are my personal performance from my account. This is January with my results. Because here they're tracked based on one contract. This is my personal, what I do for my living, okay? Then you get a risk management sheet. You get risk position size calculators for futures and for stocks. You get our rules, you get guidelines. We do offer funding for our traders. If you're interested in trading without risking your money, go to our website. It's right on the homepage. And we provide with lots of other information. So if you guys are interested, head on right here on our website, tradeoutloud.com, and go under the services tab, and you can join our trading room. Thanks so much, Ken.
Yeah, well, thanks, Anka. An outstanding presentation. I was really impressed. You really know your stuff. Very interesting approach, and I like the consistency and the intelligence that you put behind everything. You've got a very well-developed, a very mature system here, and it's very smart, too. So it sounds great. The first time we've worked together, but it made a great impression. So thanks so much for being here, and you're certainly welcome to come back anytime. So thank you very much, Anka. And everybody, she's at www.tradeoutloud. That's Anka Metcalf. She's a pro. She knows her stuff, especially a good person to learn from. So appreciate you being here very much. Thank you.
Thank you so much, Ken. Good luck, everybody.
Thanks. All right, traders. Well, we are going to continue on here. And let me switch over to Norm. Norm, are you with us?
Yes, I am. I think Anka needs a little bit more energy. Oh, this is going to. But
I know.
Other than that, I think, she made a lot of points in a half hour. I'm hoping to squeeze it, like same kind of value in here. So I appreciate you having me, Ken.
Yeah, sure thing, Norm. It's she's a smart lady. She knows her stuff. I was impressed. All of our speakers, and you too, are all good people. That's why I've invited you here, because I want to stand out from all the YouTube stuff and the other multi-speaker events that aren't wonderful. This is wonderful. So let's see, Norm, are you able to take control of the screen? I just wanted to check.
Let's check it out. Yep, I do have now. Let's take control here. That's what we like as traders, control.
Absolutely. Hey, so So traders, I wanted to introduce Norm Hallett. He and Mish have been great for helping traders with their mental mindset and many other parts of effective trading. I've known Norm for, we are old, man, aren't we? We've been around forever. I've known Norm for...
Speak for yourself, Ken. Speak for yourself.
I'm almost 60, but we've known each other like 15, 20 years. Norm's one of the great guys out there. He's really helpful. He's got a great reputation. He's honest. He's authentic. He's genuine, and he really cares. He really tries to help traders. I can tell. I've listened to the guy and worked with him for a long time. So anyway, Norm Hallett from thedisciplinedtrader.com. Take it away.
Thank you. And that's the bad news that Ken just gave you. Thank you, Ken. Ken is, he's kind of, I'm going to say you're like glue, Ken, in the industry. You've pulled so many people together in the past.
Yeah.
I mean, really, from the first 15 years ago, you pulled me into something that I never really escaped from.
In a good way. Yeah.
Again, you surround yourself with quality. So I appreciate you being here. Today I'm going to be the glue, if you don't mind. I'm going to be the glue that kind of puts everything probably that you've heard today together, because without trading in the zone, without confidence when you trade, without really these 4 keys that I'm going to give you, none of this is going to work for you. You need to be disciplined when you trade, and discipline is a word that most people avoid and believe they don't need until they've blown out 4 or 5 accounts, and then they realize that they're going to have to change something. But that's not you, because you're here today, and I've got a limited time, so let me put this together for you so you can get on with your beautiful Saturday. I'm going to cover the 4 keys to trading in the zone. I'm going to give you an offer at the end I think you're going to really enjoy and benefit from. So let's get into it. The 4 keys to trading. The key to my life is my wife. That's my wife. This is our 40th anniversary. One key to life is finding the right mate. In my case, it worked as a double whammy. As Tisha, my wife, is really the person who puts together a lot of the mental and emotional assets that we have. She's one of the world's well-known subconscious trainers. I'm going to mention her a little bit more in a second. But first, how about me? Who am I? I was known for the first 20 years of my career as the guy who writes trading plans. I did work for a number of different firms. I'm going to show you a couple of those. I've written several books. I think these 2 are still available on Amazon. Actually, this one I think was early in our career, Ken, where this one was somebody recorded one of my presentations at the Traders Expo, which I think Ken was presenting at that year, at least not only stage, but I think he also had a booth. And this right here is what I really hit the map on. And that was my over 200 4-minute drills for traders, where I talked real life right between your eyes on specific topics. After about 100, 120, I felt I started repeating myself. So I took things from different angles. Wound up 203 was the last one. But that's probably where you've seen me, if you've seen me. I did spend some time with Payne Weber. I put it up there because it's a name that you recognize, but only a couple of years with them as a commodity specialist. But it's funny how you believe those firms are there for you, and they are, but they're also there to sell you. And it was really more of a sales job. I really didn't like it. I started my own commodity trading advisory firm, Howlett Commodities. Guess I couldn't think of a better name, and cleared through my own IB, etc. But then the last 15, almost 20 years now, I've concentrated on what I believe is the most important aspect, the big missing piece for traders. They most have pretty good trading plans that come to me, but they just couldn't get themselves to have the wherewithal to run it. And Anka smartly went through a number of those areas. Anka and I are friends, and we work together and from time to time helping traders in our way. So not only Anka, but most traders worth their salt will, and most traders, most experts understand the meaning and importance of mental training. But the problem is, it's very hard to get traders who are heady normally to say, hey, the problem is not my trading plan, it's me. So, it was me. And now I think you have to ask yourself, is this the time for me to make a change if I'm not getting the results that I want? This is a little bit about my wife, who again, she's recognized as one of the world's top subconscious trainer, innovator in the field of subconscious training over 32 years. In the 80s, when I met Tisha, we got married in 1981. She was authoring the Fast Start program for accelerated learning to improve students' study habits, memories, concentration skills. And since 2000, she and I focused primarily on helping stock, futures, and forex traders to be more disciplined to follow their trading plan. And she is really the co-developer along with me. Really, she's the lead person in developing the Disciplined Trader Mastery Program. Other credentials, I can name them. I listed a few here. Let's get into the heart of the presentation. What is trading in the zone? Trading in the zone means that you're trading with calm, patience, and confident focus. A lot of different definitions, but this is the heart of all the definitions of trading in the zone. Mark Douglas, the late great Mark Douglas, wrote a book of that name. And of course, we knew each other way back when. The first key to trading in the zone is trading on solid ground. You got to believe in the why of your trading plan. Okay, you need to test your plan. Why do I believe in this trading plan? You need to be on solid ground. You need to test your trading plan. One of the things that I always recommend, and I've never heard anybody do this or recommend this, but I'm going to recommend, if you take nothing from this talk today and you're a trader and you find yourself wavering in the middle of the day and losing your focus, you wind up revenge trading, etc. Think about doing this, what I call the quick test refresh. Every day before I trade, to this day, and those that trade with me that I coach and so on, we take a look at yesterday's trading. Most of us are day traders. We're out mostly at the end of the day. And we look back at what if I had followed my rules yesterday, what would have happened? And as you go through your trigger and your results of taking every trade, you will come to the conclusion that, hey, if I had followed my trading plan the way it is written, I would have made money yesterday. And the idea is that if it doesn't work like that, if you don't come to that conclusion after looking back at yesterday's trading, you look back at the next day and the next day. Certainly by the third day, you could say to yourself, if I had followed my trading plan for the last 3 days, I would have made money. So there are days where you're not going to make money, but generally in a good trading plan, one that's worth calling a good trading plan or naming it as a good trading plan, over a 3-day span, you're going to make money. But generally, it's going to be pretty much every day, and you're going to see that kind of confidence really in your trading plan puts you on the solid ground. So try the daily quick test refresh. I think you're going to find it very enlightening and very empowering as you trade. You want to keep your plan as simple as possible. I didn't mention the first thing that I did in my career really was I was with a very large option group, in fact, the largest in the country at the time, back in the 80s. I wound up running the firm, the home office, after a couple of years. I noticed I had 60 traders at the time, and the same with Payne Weber to a lesser degree. But I had traders under my watch that I had to make sure that they were making money for their clients. They also had different trading plans, but as long as they make money, I was okay with it. Those that seemed to be inconsistent were those with all the junk on their plans. My advice to you is try to make your plan as simple as possible. Simple is good in trading. In fact, I think simple is largely required in consistent trading. The first thing you want to do is to recognize any part of your trading plan that is redundant. If you're using a MACD and you're using an RSI, yeah, some can call one proactive, one looks into the future a little bit more. But generally they're an overlap. Choose one and go with it. Clean up your chart, okay? It's easier to test when you do it. You can find the right balance. You've got to find the right balance between all of the conditions that you're putting on your chart to confirm a trade and what you really need to confirm a trade. You got to do that kind of testing too. Let's get into key number 2, believe in yourself. This is where, when you lose confidence in yourself, this is where things start to unwind and you start over trading, revenge trading. You start doing the things that cause you to take a profit and turn it into a loss. You got to believe that you're ready to win. Now, I call it positive expectation. I've done hours in talking about the powerful concept of positive expectation, but quickly put, when you project that you are a winner and that you will have a successful day, what happens? Thoughts are energy. I'm going to show that to you in a second. What happens is that you responded with options, not commodity options, but choices to make. And you make a choice and you go down that path. If that path is not a profitable path, then you continue to positive expectation, you'll be presented with another choice, with other choices. You keep on making choices. The idea of making choices to stay on that positive road, this is the essence of good belief in yourself. Because if you get knocked down in trading, it's not you. It just means there's a better alternative, okay? And you have to just continue to seek a better alternative, because you know that there is winning in the future for you. And that belief sometimes is hard to maintain when all you do is lose. So what you want to do is just to make sure that you have that simple trading plan, that you've tested it, that you've done your quick review, that you come to the table with positive belief in yourself. You got to do the work. And most of the time, you don't need to learn more. Joe Ross, who is a mentor of mine, the late Joe Ross, passed away last year. He's written several books on trading plans and trading and so on. But you know, he said to me one time, I was looking at all the books on his shelf one time. We were talking on Zoom, and I saw all the titles, even a number of his books. He says, I don't even read my own books. He says, at some point, you have to stop the music. And you got to say, hey, I know enough. It's time to execute. It's time to make that happen. So, and that's the point at where you believe in yourself. You've done the work. You've done enough to make it happen. Let's take that, what I know, make it concise, develop a trading plan, make it happen for myself. So you don't need to learn more. Believe that you have what it takes to win. There's no educational requirements. We've all heard of the person that, I mean, sometimes you look at somebody and say, hey, I'm smarter than that person. You know, why aren't I? I mean, that person, was doing something that didn't, how can that person be winning? And no, it's not about education. It's about having a quality trading plan, and there are thousands of them out there, and the quality of self to run that plan. Winning is a process, your plan and your confidence. You have to appreciate what you've accomplished. You know, if your daily goal, and I have a little bit of an issue with a daily goal. We can talk about that at some other time, but if you want to make $300 a day or $500 a day, and you only wind up making $100 a day instead of $500 or $250 a day, 50% is great, 30% is great. You got to look back. You got to take a look at where you are right now and look back at where you came from and appreciate where you're going. Not every day is going to be 100% day, as long as you're making positive gains. And if you had a day where all you did was have losing trades, but you only lost 0.5% instead of a limit of 1% or 1.5% or whatever of quality, but it was one of those horrible days, that's a great day. You followed your trading plan, just didn't work that day. You have to believe in yourself and that your future is solid the way you have it set up. Okay, the third key is to keep your need low. This is huge. Traders that come to the table with $5,000 or less, you're going to have a rough time. You better really take what I'm talking about. Everybody needs to take it seriously, but to take it seriously in this respect, if you need to be profitable, then you won't likely succeed. Okay, you have to ask yourself, can I afford to lose? Can I afford to make this trade? Can I afford to be doing what I'm doing? If you can't afford to lose with your back against the wall, likely is that you're not going to win. Where would you be if you did lose? You have to ask yourself, where would I be if I did lose? Would I be okay? Would I be a whole person? Would I be risking anything that I need in my life? So you need to do that. We all know that. But I don't think we realize sometimes that the size of an account is important. Once satisfied that you're in the right place at the right time. You can afford to lose what you have. That's when you turn it off and you focus on that positive expectation. There's also a wisdom in multiple streams of income. Okay, it really takes the pressure off one stream. So if you have a multiple stream, being a retired individual, say, and you've got some of the check coming in from the government, or something, that's a stream of income. I'm kind of talking about in a way, but if you're, I didn't start trading full time till I knew I could make $5,000 a month and replace what I was doing at the time. This was, of course, 30, 40 years ago. But the idea is that you have to say to yourself, I'm not going to let go completely of what I have. Anka talked about trading 2 hours a day. That allows you to develop another stream of income or another avenue that brings in money. You got to take the pressure off yourself. If you're trading against the wall, it really is the kind of pressure that you don't want. I want to just throw in an idea. I've been working a lot. My latest focus really has been on prop trading, where you get money from a firm, usually some sort of I don't know, the word is slipping me, but a hedge fund or some other firm. There are a lot of firms out there that are willing to let you trade their money for the lion's share of the profit, like 90%. Now they do that because they charge fees while you're testing, and most people don't pass the test, even though it's very passable for a responsible, disciplined trader with a decent trading plan. If you're interested in prop trading at all, that's not this discussion, but I know there's a lot of interest. Email me. That's my email. It's my direct email. I'll send you some information on that. I've written a paper on prop trading. So Hallett at thedisciplinedtrader.com. If you're interested in what that is all about, because I've been coaching traders, we all get together and we qualify. And I want to make sure that you have asset there if you wanted that. Let's get to key number 4. Have a support system. Okay, it's just not you and your computer. You got to give yourself access to mental conditioning tools. I mean, the market is pounding us mentally every day. It's supposed to go somewhere and it doesn't. It's supposed to stop and it just keeps going. The market is in control. Okay, we need to control ourselves and apply that knowledge about the market to the market. Okay, so give yourself access to mental conditioning tools. I'm going to give you access right now and to understand how the brain works. One tool is meditation. It lowers your cortisol level. It lowers the stress hormone. It's a tool for rapidly changing your subconscious mind, your beliefs. Okay, Steve Jobs, Joe Rogan, Bill Gates, Jerry Seinfeld, everybody. I was big on autobiographies for a long time. All these guys and more, just about every CEO that I've ever bumped into meditates. They may not. 10, 15 years ago, they may not have admitted it because it puts you in a category of your head in the air, but not anymore. This is something that's really a necessity. You got to bring down your cortisol level. And I'm only talking about 8-10 minutes a day. This is what our meditations are. And positive suggestions specific to trading in a relaxed, focused manner. That's what I suggest that you do in these meditations. Give yourself positive, specific to trading. That's what we offer our traders, to get your head together and be able to manage these points that I give you. Also, there's something called affirmations. I'm not a huge fan, actually, of affirmations by themselves, but because of your mind, the fact that your mind can only think of one thought at a time. If you're listening to an affirmation, you're occupying your mind with that thought. But in synergy, there's a synergy between doing affirmations and going deeper with your mind, with how you're changing your mindset, and that's with meditation. But if you do meditation and affirmations together, there is a synergy. I have to admit that most of our traders only meditate, but if you can do that a little bit extra, you'll get that little extra out of it. Most traders that work with us, they're just committing to 8 to 10 minutes of meditation a day with the specific meditations that we've designed. So let's take a look at the peak performance assets. Right here, this right here is an actual photograph, electron photograph of, I'm going to call it the subconscious mind. That is a neural net. This neural net controls how you respond to a stimulus. So if you're over trading, if you're hesitating, to take a signal when your trading plan tells you to do. For instance, you're hesitating to pull the trigger on a trade. Here's what's happening. You see these little tendrils out here? These are actually thought energy. This is actually what these are. This is thought energy. They're carrying a thought, and that thought can be, boy, I just lost in the last trade. I better be a little bit careful with this trade. You know, I've been trying this for so long. I'm just not sure this is for me. All these doubtful kinds of thoughts of like content, they will create a neural net that your subconscious believes in everything that you tell it. So when you're in a meditative state, or in just any kind of state of high anxiety, you're going to be feeding your subconscious mind with these thoughts and forming a neural net. So this way, when your trading plan gives you a signal, the stimulus to take a trade, you're going to, it will consult your dominant neural net. And this dominant neural net, from the way I've just built it for you, is saying, hey, wait a second, take your time, you know, make me wait 2 or 3 ticks to see if it's going in the right direction. Of course, it starts to, and you think, should I chase it? Should I not? This is the neural net that is causing you to hesitate to pull the trigger. So what do? How do you fix that? What you do is you get into an alpha brainwave state, and I'm talking about that meditation that you talk about, that I talked about, and you allow the suggestions. I'm a wise and disciplined trader. I do the things that a wise and disciplined trader does. When my trading plan gives me the stimulus to take a trade, I take it without hesitation, because I know that my tested trading plan will result in what I want, and that's a successful, profitable outcome. I'm a wise and disciplined trader, and I'll do the things that a wise and disciplined trader does. You do that in a meditative state. These neural pathways, same neural pathways, only they're carrying the messages that I've just described, will now start to create a new neural net that, if strong enough, and I'm talking about meditating once a day for 10 minutes for a week. You do that over the course of a week or even 2 weeks for the hardest head. Okay, you will build a neural net that will replace that old one that I've described, so that when your stimulus comes to take a trade, you will take it without hesitation. Why? Not because you're a genius. It's only because your subconscious mind is now, it always controls your actions. So if you want to see what your dominant neural net is, look at your actions. If you're revenge trading, if you're hesitating to take a trade, if you're controlled only by fear, it means that the neural pathways that you've created are not serving you as a trader. Let's build quickly, the way I've described, neural nets that will serve you as a trader. I wanted to show you one more picture. This is actually from last year, Cold Spring Harbor. This is a scientist at the Cold Spring Harbor Laboratory announced today that they've discovered a new neural circuit linking deep fears with an area of the brain stem that controls behavior. This is exactly what I'm talking about, only a more ominous looking picture. This is that neural net that I talked about. So this is real. It is science. It is what is stopping you from running a trading plan the way you should. Here's the Disciplined Trader Mastery Program. I want to give you a special pricing on it. It's not prohibitive pricing. And I really want you to take advantage if you're struggling, okay? It comes with a 30-day guarantee, but I want you to have this if you believe that you need it. And if you're not winning consistently, think about the fact that let your guard down a little bit. Understand that you're not alone, and that you have recourse in what we do. I will help you. Tisha will help you. And I want to show you exactly what it is. We start with 6 core subconscious training meditations. The first one is hesitate to pull your trigger. That has you become confident to pull the trigger. I've described a little bit of that in my example. Overcoming thoughts of fear and greed. Believe it or not, fear and greed are related, and fear is really the base of most issues with traders. Trading to make money mindset. I think Anka mentioned it before me in a very intelligent way, that we're here to make money. And there's nothing horrible and bad about that. It's good, because the money that we make, it means that we can do the things that we want and help things and conditions of what we want. You know, it's funny, 43 years ago, I got married to my wife 6 months after I met her. And so in 1981, in the spring, right at the end of the winter when we met in San Francisco, the first night we met, she asked me, We met at a bar called Henry Africa's in San Francisco. I walked up to her car, and I opened the door for her. We did that in those days. And she said, what do you do for a living? I didn't want to tell her I was running an options firm, because I didn't think it had the, I think it was almost, because I considered it more gambling than anything else. I didn't think it was a stand-up thing to do. So I said to her, I'm a philanthropist. This is what I said. And she has held me to that to this day. So, when I make money, I know that 10% is going one place, another 10% is going to the animals, another 10% is going to places like St. Jude and so on, where we're helping kids. But whatever it is for you, making money mindset not only can take care of yourself, but you can help take care of the world. Whatever it is for you, making money is the root of helping those people. There's nothing wrong with that. And the make money mindset reminds you that you're here to make money in this meditation. And in order to do that, you need to stick to your trading plan. You need to have the conditions that I've talked about. Straight to take your losses. If you can't limit your losses, if you can't stop the bleeding, by design, you're going to run into problems. So you need to strength to take your losses. Exercising patience. Anka talked about it, so did every trader that you heard today. If you don't have the patience to wait for the trigger, you're going to wind up taking B trades. It's not going to work. You need to stick to your A+ trades, and you need to sustain that discipline. You need, and the sustaining discipline session that is about a 9-minute session. And what it does is take suggestions from each one of these and put it in one meditation, so that I like you to do these and eliminates whatever issue you have first. If fear is your issue, if pulling the trigger, do these meditations first, conquer that situation, turn it around to confidence, and then use sustaining discipline at the end, okay, where you're now maintaining those assets that you've built that are now your dominant neural nets. Because every time you have a new thought that will feed that positive neural net that you built, it's just going to maintain and build that neural net, okay? So these are the 6, there are 4 other ones. I just gave you the 6 core ones. But the thing about it is your brain's like an onion, and many times just solving the strength to take your losses is like a domino effect, and all the other minor situations get knocked down, and all of a sudden you thought you had a problem with fear, but it really was just the strength and the fear around taking your losses. You solved that, and all of a sudden things were on their way very strongly, and you move to the sustaining discipline. But sometimes it unlocks other things. You may have thought it was fear and greed. You take a look, you listen to the fear and greed, you've helped yourself with fear and greed, but you realize that you still have an issue with patience. And so you can take it one by one. Sometimes it opens up the door for what is real for you. So this is the process, and it can be done literally in a 2-3 week period. Okay. I'm also going to give you all those 208 4-minute drills for traders. You can look it up and find 1 or 2 of them around it. A lot of traders have taken them. I've given them to traders to help their people, 5 here, 10 there, but I'm going to give you access to all 208 in one place. This is kind of one page out of that, but you can see the kinds of topics that I cover in quick, between your eyes kind of a thing, similar to what we're doing here, only even more direct. The psychological impact of losing money, discuss that in 4 minutes. Capital preservation main points, I give them all to you in 4 minutes so that you can start your day. People listen to this, traders listen to it, they'll turn it on in the middle of the day when they need that extra push. 208 of them, okay? So I wanna give this to you as part of the Discipline Trader Mastery Program. If you're new, there's a basic series. If you're not new to trading, you can use it as a review, but go on to the core area right away with those subconscious trainings. Building and running your trading plan, risk management is key. Journaling, I got to tell you, I've got a simple way of journaling, 3 minutes a day. If you're not journaling, I want to show you how I do that. And trading as a business, that was something I got from Joe Ross. Actually, trading as a business area is an interview I did with Joe about framing your trading as a business. Don't kid around. Don't try to trade. Don't I think I want to. No. I'm in business. This is serious business. And I teach you how to frame things. So that's the basic, okay? I also give you what I call the Discipline Trader lifestyle. It's 101 the other meditations. I'll only say that when we started our business, Tisha and I, 20 years ago, we were helping golfers, tennis players, and we came out with 100 different meditations plus. I'm giving them all to you. Why? Because traders who have turned around their mental and emotional game all of a sudden realize that there are other parts of their life that wish they had. They have a child, say, that gets nervous when they take a test, and so they're smarter than their test. There's a session here on relaxed test taking. There's one on better memory for students. There's all kind, and look at these different categories: personal improvement, weight loss. There's even one, and don't jump to better sex right away. Okay,
that got my attention, but okay.
Yeah, and so you're right to the thing, and just please do one in golf, then go to the better sex. But believe it or not, actually, the better sex has some of the same with a male voice and a female voice. So sometimes you don't want to hear it from a male, you want to hear it from, depending if you're a male or a woman, or if you're straight, gay, or something else. You want to hear it from a person that the kind of voice that resonates with you. But all the others are in Tisha's voice. Physical fitness. I just want to tell you, listen, this is not about trading. Listen, don't confuse life with trading. Trading is part of your life. It's not your life, but making it the part that makes you money. Okay, but I want to let you know, I'm giving you other things. When you realize it for yourself in your trading, you're going to want to do it for other parts of your life. Okay. Craig, he said, the information in your program is unbelievably valuable. Keep up the great work. You're helping many fledgling traders like myself to improve and be consistently successful. I underline consistently successful because, you'll hear a lot of trading plans from the first week they tried something. I can see this is going to be. No, this is the end result. Consistent success. Okay, thanks as a subscriber to your program, helped me. A lot of things have been coming together for me, my plan, my psyche, my risk management. I have become a more consistently profitable trader. Okay, so you don't have to be wishing that this is going to happen after a while. It's happening. It can happen for you. Look, I seldom meet a trader. I mean, literally 1 out of 100 that I don't think can turn it around and make it happen. You're 99%. This is you. Consistent profitability can be yours. I'm not going to read all through these, but these are just clips of traders over the years that have said things. Please don't change. Thank you for making me a disciplined trader. You need to be a disciplined trader to make it happen. Here's my 30-day no risk money back guarantee. If you are not experiencing a shift into the zone when you're trading, and you don't see it, you're not experiencing that relaxed confidence focus to run your trading plan, I'm going to refund your investment. I have no qualms about that. Because listen, if it doesn't work for you, I don't want you to have spent your money on it, but you're not going to, that's not going to be the case. You're going to be that 99% of the people who 30 days risk. Look, the risk is on me. So here is a fast action bonus I want to give you. It's good till 5 p.m. today. Actually, it's good till the rest of the day today because I'm presenting late here. But the price is good for the weekend that you're going to get. But the fast action bonus, I want to give a little bit more to those that are a little bit more incentive to those that this presentation is vibing with. Okay, I'm going to give you my original simple 3 trading plans. We have a 4th one that's a little bit more in depth that we use for a number of other issues. In fact, even in our prop trading, we use the what I call the loaded gun trading plan. But I wanted you to have what started it all off, the 3 simple trading plans. They fit on one sheet of paper. The first one is called the Big Move Potential. It's a trading plan that is really designed to tap you into a trend that's just beginning in a high probability way. The second one is called the Continuation Plan. It's one that watches for an established trend, watches for a correction, and actually uses Fibonacci in this continuation plan to identify when a market is about to continue on that plan, on that trend, rather than be a reversal of a trend. So this is one that helps you prevent mistakes and get into a trading plan that's just taken a pause for the cause and ready to go. But believe it or not, the most popular of the 3 plans is something called the Extremes Plan. It uses Bollinger Bands. And what it does is it concentrates on the snapback in overbought and oversold markets. And this is one that traders seem to enjoy more than the others. I don't know why, but I think it's because they they believe it's a counter trade and somehow they're makes them different or whatever, but they all work for you. They all approach different trading scenarios. And I want you to have these 3 trading plans. I'm going to give these to you if you order this today. Okay. And here's what I want you to consider: the simple trading plan as a bonus for people who act quickly, but the Disciplined Trader Mastery Program, again, the 6 core subconscious training meditations with the matching affirmations. That's a $1,497 value. I've given you all the suggestion, all the problems that traders have, and we know. Listen, we've been working with traders for 20 years. We'll reverse these for you to make them move from fear to confidence. I'm going to give you the 208 4-minute drill for traders. That's worth $1,140. The basic series 697, good for review, a mandatory for those who are just in their first year of trading. And I'm going to give you the 100 lifestyle meditations, $997. This is a total value of $4,331. I am going to give 88% off this. Now, I know it sounds crazy, and when I say it's going to be $497 to you, that may feel it taking away the value. No, this, when it first came out, the Disciplined Trader Mastery Program, with about half the material that's in there, it was on 12 CDs, and we sold more than 1,000 of them over a 3-year period for $1,997. So this is a real value. I want you to be a disciplined trader. I want you to start to give to those, help yourself and give to those causes that you want. $497, it's equivalent to $41 a month. Okay, so $497 is the yearly charge for this. If in that first year you don't like it, tell me anytime. We'll stop for the next year, whatever. But I want you to have the price that is right now, okay? Because the price is going up in the middle of the year. But I want this is the $14.97 is going, but I want you to have it right now for $4.97. I want you to take advantage of the fast action bonus and have the 3 trading plans, fast action, simple trading plans. So here's the link. It's a little hard to read. You can actually click that and go right to the page if you want. But it's thedisciplinedtrader.com/MP as in mastery program. Disciplinedtrader.com. All I'll say in the end here, and I appreciate the opportunity here. I know I've gone a few minutes over, but listen, it's not going to work for you unless you make yourself the solid citizen that you know you can be as far as a professional trader. If you're not looking to be a professional trader or have the label of a professional trader, you really shouldn't be doing this at all. This is not a game. It's an outcome that you can have by defining yourself and acting and doing what a disciplined trader and a professional trader does. It's funny because this is something that I remember the first time I think that you're both presenting on stage. Remember Ken and I were presenting, and when it's lunchtime and we get to talk to each other, we look at each other and they all know I'm about the mental and emotional part. And I always say, it's so hard sometimes to get people to do it. And we look at each other and we shake our heads. I mean, we know why it's hard. You got to face your own ego, and that's a tough thing to do. But let's drop the ego. Let's drop the ego. Let's talk about the ego at a cocktail party and how we recognize that we were our own worst enemy and that we were ready to do it. I want you to do it at a price that's not resistive. Okay, $4.97. You got to do this by today. If you want the fast action bonus, if you want to think a little bit and you have your own trading plan that you don't want any other input, that's fine. But get it together before the weekend and take advantage of the $4.97 pricing. Ken, I can't tell you how much I enjoy being with you, even if it's only virtual. We always look at each other and start laughing because we've had so many great experiences as really mentors to traders. We tell each other our crazy stories of somebody that was in the ashes, and we helped them out through the Phoenix. But that's where we get off. That's where we get off, and that's why I enjoy working with you, Ken. Again, in this
thanks,
virtual
Norm. Thanks, Norm Hallett, for the presentation. A really good deal. Comes with the money back guarantee, and I've known Norm for a long time. And for the price of a blown stop or two, hopefully you can it's like good medicine for traders, and it really helps get your mind in a more positive mindset, because it's easy to get, as we all know, it's easy to be disappointed and discouraged and upset and frustrated with their trading, having some guidance and some ideas to keep you guys on path can really help. And Norm Hallett's top notch in doing that. So highly recommend Norm Hallett. He's been somebody I trust. He's got a good reputation. Otherwise he wouldn't be here, right? He's one of the good guys for traders. So he and Mish or Tish, I'm sorry, really good to help folks. So thanks, Norm, for being here. Appreciate it, man.
Thanks, and thanks for having me follow Anka. It made me seem like a relaxed presentation.
Yeah. Well, you're all good. You're all rock stars. So thanks so much, and thanks, Norm Hallett. Okay, well, we're gonna wrap up with Bennett McDowell. And Bennett, thanks for being here. I know we're running a bit late here, but it's worthwhile, right? These presentations are all less than an hour, so good stuff. Let me.
Ken, how are you? Can you hear me okay?
Yeah, you're coming through loud and clear. And yeah, I'm sorry, we're running like 10, 15 minutes late today because
no worries. No worries.
Let me make you the co-host. And
all right, let me make sure I get all my screen sharing hooked up, and
now you should be good to go.
Hey, Bennett, could I apologize to you? I actually thought I was the last presenter, but I'm really glad to see you here.
Oh, no worries. Hey, Norm, how are you?
I'm excellent. Great to see you too. We're like a club here, and it's because we've gone through the pain. We've come out on the other side, and that's really why I really enjoy people that come to these webinars to be better traders. So take it away, Bennett.
Absolutely. Thank you. Great presentation, Norm. Yes.
We got good people here. So thanks. Let me go ahead and do a quick introduction, and let's see. So So we've got you speaking right now, and let's go ahead and get underway. Okay, so let's see. I'm trying to follow up here. Okay, so we got Bennett McDowell from traderscoach.com. I've known Bennett for many, many years. He's one of the good guys out there. You know what I picked up from your last presentation that I found especially valuable, Bennett, was the multi-time frame approach, because it's really important to confirm. And the other thing I really like to remember, just to tell you guys listening out there, is he's got a really good approach to help you kind of develop not only LA Wave 1, 2, 3, but kind of figure out the right side of the chart before it happens. And so really good structure, good intelligent approach, and Bennett's got an outstanding reputation. I've known him for like 20 years now. We're like we've been around for a long time. So thanks, Bennett, and take it away. You got a full half hour from now. So thanks so much. And traders, I will stick around afterwards to do a quick recap, and I'll even play saxophone if I still have energy. So anyway, Bennett, thanks for being here, man, and take it away.
Yeah, Ken, I've actually heard you're quite the saxophone player. So Gene told me you played last time, and it was quite good. So I'm going to stick around for that.
Okay, thanks, man.
Good. All right. Okay, so let's go ahead and get started. Today, actually, I'm going to talk about psychology. So I'm going to kind of piggyback onto Norm's presentation, because he touched a little bit about psychology. So we're going to talk about making your psychology work for you and not against you. You know, I want you to think back, everybody, to when you first started trading. I don't care if it's 5 years ago, 10, 30, whatever. But when you first started trading, did you ever think psychology was a key increment or part of becoming a successful trader? I know I didn't. All right. I had no idea. I just thought you got a trading system, you entered the market, you exited the market, and life was good, right? Well, when you start trading, you start to realize that, oh my gosh, am I trading against myself? Or am I trading against other market participants? And a lot of times you got to be careful not to fall into that category where you're trading against yourself. So we're going to talk about some of the concepts that can keep you from doing that today. In addition to, I know with all the automated trading here, people like to say, well, I can eliminate my psychology through automated trading. Well, not really, because a lot of our quote unquote automated trading works in some markets, but not all. So you still need to get involved and take hold of the reins, so to speak, of how to interpret your indicators during different market cycles. And so I think really, no matter how much we try to separate ourselves from actually us trading the markets, it really is us trading the markets, right? So with that in mind, let's go through some of the material here. I think it'll kind of be insightful for you and also actually help you. All right, now, of course, there are risks involved in trading. We always have to start out talking a little bit about the disclaimer here. And we do want you to know that past performance does not equal futures performance and all that kind of good stuff. And also to trade with risk capital, money you can afford to risk and know how to do risk control, quite important. All right, so we have a website called traderscoach.com, and I invite everybody to come to it. We have a bunch of websites that all filter back here. We also have a YouTube page And I think Gene's going to put a link up there if you want to join our YouTube page. Every Friday, we do a free, basically stock picking service or evaluation. And so you're welcome to join us every Friday, 8 a.m. Pacific time. So I always like to throw out that. Also, too, we've got a number of books available. I've got a new book coming out this year called The Art of Trading. It's a second edition. And last year I came out with Money Management for Traders. So if you need help with risk control, great book for you. And if you want to learn basically about our trading approach and how we use that multiple time frame analysis that Ken was talking about, the new Art of Trading book is going to be great for you. So you can pick those up, and Gene will try to put a link up there as well for you. All right, but today we're going to talk about psychology. And we do have a free print for you guys taking the time coming here. So you may want to get a hold of this. We're going to talk about what we call the trader's mindset in this free handout, and basically talks a little bit about what you need to know and do to acquire the trader's mindset. And a lot about that is some drills on self-awareness. And we talk about some of the destructive psychological trading issues and their causes and how to correct them. So that is in that handout. Definitely, Gene will put a link up for there and you can access that as well. All right, psychology is important because stress, worry, fear, greed can certainly ruin your trading. I know Norm talked about revenge trading, and that's all part of the psychology mixture. If you're mad at the markets, if you don't have the right temperament, usually caused by the way, a lack of structure, all right, you can go down that very destructive emotional road of basically revenge trading, or even angry trading, I call it. So psychology is important. And it really, no matter what markets you trade, no matter what time frames you trade, all right, it's gonna rear its head at times. But the good part about it is once you've got the hang of what you're doing in terms of your trading approach and your mindset, then you can learn actually how to profit from other people's psychology that gets out of control. And we see that during manic periods in the market. Those are our typical breakaway markets, and we have pivot points in the market that represent changes in behavior. And that's the fear and greed interacting. So we're going to talk a little bit about that. But a trader's improperly managed psychology can actually manifest losing trades even with a proven trading system. And it's been proven as a fact. There was a study where everybody used the same trading system. Some people were successful, all right, and most people were not. Kind of sound familiar? All right. And it's because of the fact that their psychology interrupted their success. And even Warren Buffett notes this. You must be able to control yourself. You can't let your emotions get in the way of your mind. And of course, that means making objective decisions. Now, today, we're going to talk about three significant psychological factors. All right. We're going to talk about visual perception. Is what we see really reality, or maybe we're looking at an illusion? Emotional perception. This is your mood. Are you showing up during the trading day in a bad mood, angry mood, good mood? All right. Environmental perception. What in the past and even the present is creating who you are today? So these are three significant areas that actually affect your psychology. And the nice thing is once you really see what they are, you can do something about that. So I want to go over the visual perception, and these are kind of fun. So kind of sit back and enjoy this, because you're going to see how your minds are capable of more than you realize. Visual examples illustrate how our minds can conceive and create illusions we may not even be aware of. So the first little exercise I'm going to show you, take a minute and look at that. To you, is this a reality or an illusion? Are those straight lines or are they crooked? If you got your ruler out, they're actually all horizontal and vertical, perfectly straight lines. But because they're colored, you're creating the illusion that they get warped. Now that may be something, but when you look at things like this, in order for you to really believe it, you're still probably going to have to get out your ruler and measure it, because the deception is quite incredible. All right, this next one is fun too. Take a look at this woman on the left, the negative, and focus on the point on her nose, and do that for 20 seconds. Do that for 20 seconds. Then look to the right on the white screen. What do you see? A pretty girl, right? Right, a woman, right? I see a brunette. But in any case, again, there's something going on inside that's creating that perception. Take a look at this one. Count the black dots. Pretty hard, huh? They all turn white, right? And I could go on and on with these type of examples. They're kind of fun, but it kind of illustrates a point here. And that's kind of what I'm driving at here. Visual examples illustrate how our minds can conceive and create illusions we may not even be aware of. Illusions may be visual or may be created subconsciously by even the emotions created by our beliefs. Learn how to control these powerful illusions created within. So you're going to have two types of possible illusions in there. You could have illusions just by the fact of the trickery of the particular colors in a diagram or whatever. But you could also have an illusion that is somewhat not necessarily controlled, but influenced by your mood and your belief system. All right, visual examples illustrate how our minds can conceive and create illusions. All right, of course, you know, for us here, this leads us to ask, are we seeing the market as it really is? So what does this have to do with trading? All right, if we look at a chart like this, think about this, look at this, don't think too much, but does that create much emotion? How about you? How many out there, does that make you emotional? Kind of like a sideways market? Not really, right? Kind of boring, right? How about this market? Does that create more emotion? Sure, right? Well, guess what? Throw up. Guess what? Both charts are the same. Both charts are the same. So it all depended upon how I stretched the price axis. So sometimes we can create or manufacture fear or greed by ourselves, just how we are positioning what we're looking at. And that includes charts. Kind of weird when you think about it, right? Interesting. So keep that in mind. When you're looking at a chart, all right, remember that it may not be as bad or as good as you think it is. And this is why during technical analysis, all right, you have a set of rules to follow, because if you stay within those rules, it keeps you from being deceived by what you're seeing. Does that make sense? Kind of a cool, fun little illusion, isn't it? Again, I could go on and on and on, but that's kind of the idea. Now, there's another type of perception, okay, called emotional perception. So that was visual perception. Now we're going to move into the realm of emotional perception. And without thinking, you don't have to write this down, okay? Without thinking, write down an animal that the market signifies to you. Real quick, don't think too much, all right? Just write it down or think about it. What animal does the market signify to you? Some will say a bull, some will say a snake, some will say a lion. Doesn't really matter what it is. What's important is what that animal signifies to you, all right? Because your answer is going to tell you much about the beliefs you have about the market. Are you creating artificial fear and greed, causing inappropriate trading responses? If the market is threatening or tricky to you, you will most likely choose an animal that could hurt or deceive you. So again, it doesn't matter really what the animal is, it's what the animal means to you. Okay, how many people picked an animal that was possibly could hurt you or deceive you? Think about that. How many picked an animal that was friendly? The usual outcome of trading from a fearful mindset produces emotional trading. And usually fearful traders exit the market too quickly or cannot pull the trigger at the right time and lose money. Okay, so if you find yourself getting out of trends too soon, chances are it's fear-based. All right, follow your system. If your system tells you to get out, and basically you're getting out too soon because your system tells you, not because you're kind of freaking yourself out and getting out, that's different. Okay, then you need to tweak the system. But if you, or maybe you created the system with a little bit of a fear base in there. But the idea is, if you're exiting markets too soon, and your system maybe is even telling you to stay in, then you're in a fear-based mindset. All right. So also too, if you're having a hard time pulling the trigger, maybe you just had a losing trade or a losing 2 trades before, and now your system is saying go again, but you're like, oh man, this has been a tough day. I'm day trading. I can't stomach another loss, right? All right. Then chances are, it's a combination of fear and exhaustion. All right. But the idea is that technically, from a technical standpoint, from a mindset standpoint, we want to treat each new trade as new, not what happened last time. Right. So actually, if you can't pull the trigger, then you're sitting in the past thinking about the previous trade, and that's creating a whole bunch of fear and anxiety that's keeping you from pulling the trigger this time. However, okay, if the market is a fun and safe place to you, then you will most likely choose an animal that is non-threatening to you. However, you can also take this to the extreme too. If you don't have any respect for the market, notice I didn't use fear for the market, but respect for the market, then chances are you're going to be kind of just trading without risk control and probably over trading. So think about that. All right. The other thing too, a good analogy I think on this is, how many boaters do we have out there? Anybody like the water, like boating? I love boating. Okay. I love sailing. All right. Now we all know the ocean can be a dangerous place, right? If you do any offshore sailing, you have hazards doing that. But you take appropriate measures, if it's, you're going to wear a harness if you're offshore, especially at night, right? Or at any time. You're going to have respect for the sea, but at the same time, enjoy yourself out there. And I kind of look at trading like that. All right. I know the market needs to be respected, but not feared. Okay. I think that's kind of where I'm going with this. All right. You kind of want to respect it, but not fear it. Now, fear is also relative. Okay. Each one of us has a threshold of what we think is fearful and not. And sometimes, or many times, a lot of the things we think we're fearful about are false, not necessarily based on reality. All right. So I love this little saying, false evidence appearing real. Sometimes fear can be real though. Okay. But a lot of times we can create our own fear based on our experiences or what we start to envision happening in the future. And that kind of takes us out of the reality of what's really happening now. So you got to be kind of thinking about that. But whether it's real or false, both create emotions. Interesting. And this is where it can get tricky, because as a trader, all right, if you have a fear of the trade not working out, then that's going to create even more fear, and it kind of feeds on itself. And all of a sudden you're an emotional mess on a trade that may be okay. And all this fear is based off what happened maybe 2 trades ago in a similar situation, or what you think is going to happen in the future. I always like to kind of think about this. 90% of the stuff we worry about doesn't happen. It's always the stuff we don't think about coming out of left field, that 10%. That usually gets us, okay? So a lot of times the stuff we worry about doesn't really come to create as big a problem as we think. So same thing in trading, okay? So you want to learn to distinguish between real and false fear, all right? Think about that, all right? So fear is an illusion of what we feel is threatening. So whether it's real or not, it's still what we feel is threatening to us, because what I may be afraid of, you may not. right? You may not. Well, how do you know the difference? Great question by William here. So I think what you have to do is kind of decide whether you're basing your fear off evidence, off the evidence, versus off the emotion of what could happen. Okay. And, you know, if you feel the fear is real, then obviously take the appropriate action to protect yourself. All right. If a bear is running after you, and you got your trusty 12 gauge or 50 cal for that matter, all right, you're going to have to use it. All right. So there is real fear, like I said, versus false fear. Okay. So you just have to distinguish that based on the evidence of what is actually happening. Good point, though. Outrun your buddy, right? All right. Now, talk a little bit about if you're, you know, we all have fear. Okay. We're all humans. We all have fear. We all agree. We can't disassociate that. All right. And the thing is that as traders, all right, this is something you just can't turn a switch on and off. It's always going to be there. It's conditioning yourself to understand the trigger that creates it and then make a conscious decision on whether to act on it or not. And hopefully that conscious decision will be based off the evidence and based off in trading your trading system, because your trading system is designed to basically keep you out of the fear and greed paradigm, right? Because you're making decisions objectively. Anytime you adjust something on your trading approach, it's usually because of fear or greed. Okay, think about that. What you want to do when you test your system is create a system that has an edge. And then you can actually believe in that system, and therefore that will be overriding to the emotion you feel when you trade it. That's kind of the idea behind testing a system and having an edge. All right, but let's talk a little bit about stopping fear now. Learn to stop fear. All right, so take a look at these 4 professions here. Samurai warrior, okay, from a long time ago, right? Combat fighter pilots, race car drivers, and yes, us traders. What do they all have in common? And what do they need to do to stop fear? Anybody? How do they stop fear? I mean, they're all in fearful professions, right? Samurai warrior can get killed, fighter pilot can get killed, race car drivers get killed, and traders get financially killed. So, I mean, how do they control it? How do they do it? Anybody want to take, they're risk seekers, okay, fine. But how do they control their fear? Knowledge and practice. Amen. Okay. Samurai warrior, how many hours or decades do they spend training? Now, I was in martial arts, okay? So I know a little bit about this, and it takes years, decades to become really proficient in a martial arts. But it's practice, 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 practice. Combat fighter pilots, practice, 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 practice. In fact, when you talk about simulated trading, think about simulation in flying airplanes. They do a lot of simulation work, so they get all the kinks out in a safe environment. And that's what you should be doing as a trader as well. Race car drivers, same thing. Practice, practice, practice. And then traders. And, the practice, when you're first starting trading, you've got to know your limitations. Okay, in all these things, because it takes time to get to the new levels you need to get to before you're at that next level. So you can't just think you're going to be great. You've got to enjoy the process of working through the different levels. Okay, so, I think that's important. So, that's really, I think, an absolute genuine way that you can control your fear is through practice. There's nothing wrong with it. All these professions do it. And I think with trading, the problem I see with a lot of traders, and I do a lot of coaching, the problem I see with a lot of traders is they don't really realize not that it is difficult to become a really good trader, but it's really more than difficult. It's the persistence to commit. And you need to really be in it for the long haul. And it's kind of like, when you hear about traders wanting to study over the weekend and hit it Monday and start with real money. Well, think about if you're a surgeon, decide you want to be a surgeon on Friday and start operating on Monday, right? These things take time. So enjoy the process. It's a great business. It's a fabulous career, more so now than ever because of the technology. We can do this anywhere in the world. You can do this anywhere, your home, wherever you want, on a boat, wherever you want to do it. You couldn't do that 20 years ago like you can today. All right. So kind of important. Humility is a big deal. That's correct, William. Absolutely. Humility keeps us humble. All right. And of course, as we know, ego can cause a problem with trading. All right. One more little aspect I want to touch on, and I think, Norm, you covered this as well. As a trader, how much emotions do you attach to losing and winning? Interesting concept. I find, again, through coaching, that people in trading expect to win. All right. So when they win, high five and they move on. When they lose, the stapler goes out the window and it upsets them a great deal. And so what does that mean? They energize their losses. They're thinking about their losses. Learn from your losses, but don't energize them to a point where you're thinking about losing more than you're thinking about winning. Right? Does that make sense? Kind of understand what I mean by that?
All right, good presentation, Bennett. Yeah, good stuff.
Yeah, good. So I think it's really important because I got to tell you, Ken, it's amazing. A lot of people will spend a lot of time beating themselves up on a losing trade. All right. And yet when they win, okay, they just move on. But again, what's taking up their mind more are the losing trades. So you don't want to do that. Keep them balanced, keep them centered. Okay. Just like Franklin said here, centered. Okay. All right. A little bit on core beliefs here. Now, to be successful in anything, not just trading, but really anything, there's some core beliefs that you have to kind of work on. And, we all come from different aspects and different histories and things like that. But it's all about really getting to know yourself. All right. Do you perceive yourself as a winner or a loser? Deep down inside. All right. And, if you perceive yourself as, not so great, that's okay. All right. But you kind of want to see yourself and visualize yourself as winning in trading. So I think visualization is really good. And I want you to work on that. Instead of thinking yourself as a loser, change, okay, to a winner. We all get stuck in these, what I call psychological dances. It's like, people that are the victim are kind of, they don't know how to dance outside that victimization. And it's actually hard for them to break that. Same thing with this, okay? If you're, always kind of the loser, you want to break that, or at least you think yourself as a loser. Break it. Try it for 30 days. Try not thinking about that or like that for 30 days, okay? And see what happens. What's your thoughts about money? Is it good or bad? Pretty hard to be successful in this business if you think money's bad. Now, if you think money is bad, why don't you think about all the good you can do with money? Maybe you can help people, okay? Donate some, all right? Turn it around, all right? About trading, is it possible? Is it possible? Do you think trading's possible? Do you think it's possible to make a living from trading? Okay. If you don't think it's possible, research it more. There's a lot of people out there that are successful traders. What about success? Do you deserve it? Deep down inside, do you deserve it? Now, some of these things, if they're really something based off, and again, we all have personal little areas, pockets in our being here, so to speak, that are deep. Okay, so if you're having trouble on a very deep level, you might want to get help for some of this stuff, because it's going to be pretty hard for you to be successful if you aren't pretty good on your core beliefs, right? Okay, so think about that. All right, go dig deep. Okay, it's not always about entries and exits. A lot of it is about, okay, what's inside. All right. So kind of that. All right, John is asking, so it is important not to energize both outcomes, but just saying neutral with each outcome. In a way, yes. What I think you should try, John, on that is when you take a loss, all right, you want to first just learn from the loss. Was it a loss because you did something emotional to create the loss? If it was, make a note of that so you don't do it again. If it's a loss and you followed all your rules right, well, put that in your record keeping. And if you have a tested edge, then that may just be one of the losses that will occur when trading your system, which is normal, because eventually, if you have a tested system, you'll be back on top, right? You don't win every trade, okay? You just don't. That's the way it is. You got to think of yourself almost like a casino operator, where you don't know what particular hand of blackjack or poker you're going to win, but you know if you play enough, you're going to do okay. All right, that's how casinos do so well. So that's the kind of what I would do. Now, on winning, you got to be careful with over energizing. I don't mind you energizing winning a little bit, because that puts you in a good frame of mind, so to speak. But you know, you can overdo that too, because what happens is some people that start winning, you know, their system may create a streak of wins. Then they all of a sudden don't feel they need risk control anymore. Okay, and they start increasing their trade size beyond what they're supposed to, based on their trading rules and their risk control. So you know, you got to be careful about that. So kind of like in the middle. But if you want to weigh one more than the other, I'd weigh winning a little bit more. Okay, so hopefully that helps. All right, so I do like to cover that. All right, let me move on here and go through the environment a little bit. All right, so we all have a unique and different environment. Your environment will impact your belief system. Now, what do I mean by that? Okay, well, what you're exposed to, okay, how can it not help but to impact your belief system? If you think about your past, think about some things that may influence your beliefs. I had, for example, I'll give you an example. I had a student where he grew up in a very structured household, and his parents were, you know, basically corporate people. And if you didn't work in a corporation, you weren't really working. And so, you know, as an entrepreneur, which we are as traders, all right, right away, you know, that puts a strike against him in his belief system, because he's been taught that all along. So you understand what I'm saying by that? Is that our past and maybe some of the things that we grew up with and were taught about, they're going to affect your beliefs, and you're going to carry those over possibly into trading. All right. And you can fix those, of course. You can fix those. Think about all the entrepreneurs that are successful. Think about trading success, okay? Things of that nature. Also about your present and how that influences your beliefs as well, your current situation, all right? And the result is we all have this unique maze, okay? We're all humans, we all are subject to emotions and the whole 9 yards. And, you know, the interesting thing is, again, is that as much as we try to get away from having us involved in our trading, it really cannot be done 100%. And I know the big thing today is AI. I know the big thing today is total automation. But you know what? It's like, you know, when a pilot flies an airplane, once they take off and once they land, okay, in between they can fly it on automatic pilot for the most part, unless they have a problem. But they still have to take the reins when they land it, and they still have to take it when they take off. All right. So it's not always 100%. Same thing with trading. Okay. So the idea is when you set up your rules, take into account the fact that the best computer you have is between your ears. And once you hone your psychology, so we're not subject to fear and greed and emotional trading, then you got something. Okay. So keep
And
that
Dan,
in
you
mind.
make a lot of good points. And Yeah, I know we're going to wrap up here pretty soon. One of the things I wanted to mention too for traders, and I'd like to hear your take on it too, Bennett. My most profitable years, I'm wrong 74%, I think is average of my trade. So I lose a lot more percentage wise, but they're itty bitty teeny tiny darts I throw. So don't expect, guys. I'm here to tell you, and ask any floor trader. You guys will never be more than half percentage, 50% right in your trades. None of us are. The way I've got an edge is my stop losses are so tiny, the wins make up for it and then some. And so that's really important that you guys have realistic expectations. That don't beat yourself up for being less than 50% right in your trades, because no professional that makes it is. We're all about the numbers in the P&L, not the percentage of winning trades. It's the size. Size matters. It's the P&L that matters, right? So what do you think, Bennett? Yeah.
I think absolutely right. In fact, I have met traders that win half the time, but because their payoff ratio, which is their average wins to their average losses, are higher, they win. Okay.
Right.
So I win with my style of trading, it's been about 60 to 65% of the time. And I'll tell people that and they'll think it's terrible, but it's actually not. Okay. My payoff ratio is about 2 to 1. So I do pretty well overall, but there's some people that I've never really met anybody, Ken, that has had anything really over 75% of you.
No, most professional traders, and myself included, we're under 50%. So my point is, you guys don't beat yourselves up. If you take 10 cent stops, but $1.20 win, you're 1% or you're 8% correct or whatever, but you still made money. So don't obsess over the percentage. It's like you said, the payoff ratio. Think like a casino operator. I like the way you said that, Bennett. That's smart. It's over the long haul. Because and it is true, because the wins are slightly bigger than the stops. You end up net profitable, and that's the main thing to focus on is the net, not the number, the raw numbers. So good stuff. All right,
amen to that.
And did you have any special? Thanks, man. Did you have any good offer for our traders? It's good comments so far.
Well, the only thing I can tell them is come to our website. We got a lot of courses on psychology there. Okay, so you can check that out. And basically, the wrap up to this is Ken, is basically when you look at a glass half full, is it a visual illusion or a belief illusion, optimism or pessimism? All right. And so think about what influences your answer to that. And that's going to tell you a lot about your trading as well. So, it's a lot about getting in touch with your triggers, getting in touch with what's going on personally inside you. So one last thing, I'm going to wrap it up here. As a summary, your mind is creating illusions you may not even be aware of. Illusions may be visual or may be created subconsciously by emotions created by beliefs. All right, your emotions such as fear, distorting what is real, and how you interpret and act in the markets is a very real possibility for many. All right, how your mind sees and interprets the markets may be affecting your trading. Again, you may not even realize what's going on. So do you think it's important to learn skills to control your emotions and identify distorted illusions before they sabotage your trading? You betcha, right? You betcha. And remember this, just like Ken says, you're going to lose a lot, but winners are not people who never fail, but people who never quit. So you always want to be working in a realm where you're keeping good records. So you know your win percentages, you know your loss percentages, and always try to tweak it, make it as good as possible, and figure out if your emotions are getting in there to throw you off, okay? Because you're not going to be able to develop the mindset and be a successful trader unless you really master your mind. All right, so that's kind of where I'm going to end it here, Ken. And again, we have this free printout that will hopefully help you. I think there was the link is good. So if you're not getting through, just keep trying. Okay, maybe the server was getting crowded or something, but keep working at it. Okay. So Ken, I want to thank you so much. Okay, for having me again. What a great afternoon here of presentations.
Yeah, well, you've been a winner too, man. All of the speakers, you guys have all been fantastic, beyond what I expected. So, and honestly, so I really appreciate it. Isn't it good people to have credible, competent, they know what they're talking about, and they can really help you speakers versus YouTube videos or whatever. So it's good to have the people who actually have the experience, and Bennett's one of the best out there, like Norm and so many, all my speakers, all great. So Thanks so much, Bennett McDowell, for being here. You're one of the rock stars, and sincere thank
my
you.
pleasure. Thank you.
Norm and all the rest of the folks. All right. So traders
All
go
right,
to
great. Thank you, Ken. All right, Ken, saxophone time.
Yeah, I'm gonna
I
try.
want to hear the saxophone, man. I'm hanging around here. I want to hear Bennett now. I want to hear the saxophone.
Okay, well let me get to it then. Now I can't promise I'm going to be great because I'm exhausted and I'm old. I'm 59. How does that happen? You just like
Tell
like
me
a friend
about it.
says, time. The older you get, the faster time runs
It goes
by.
quick. It goes quick.
So we got to make good use of our
But
time.
enjoy the journey. Enjoy the journey. That's the key.
Right, a journey well lived, and hopefully you guys all learn from each other, and we create a good community of active traders that can help each other. All right, well, let me get this party started. Thank you so much for everybody for being here. I'm going to try and play a little bit of horn. I don't suck. I'm not great either, but I'm a little bit worth listening to. Anyway, we'll start within a minute or two.
All right, Ken, let it rip.
You want to do vocals with me, Bennett?
Norm, I stepped away for a minute. No, you don't want to hear me singing, that's for sure.
Moving right along.
1, 2, 3, yeah. Come on, come on. To make the disco, but I haven't got a thing to wear. I'm gonna get my stereo and call up everyone. Come on over to my house and let's have some fun. Gonna have a house party. Everybody sing. Gonna have a house party. Everybody come on. Gonna have a house party.
Watch out.
A little Van Morrison.
Moon dance.
Oh yeah.
Almost done. Let's see. Oh, wait, let me do some classic.
I know the night's magic seems to whisper and hush.
couple of Sade songs here and we'll wrap.
Watch out, boy, she'll chew you up. Oh. Dope.
give me fever. Never know how much I love you. Never know how much I care. When you put your arms around me, I get a fever that's so hard to bear. Listen to me, baby. Hear every word I say. No one can love you the way I do, 'cause they don't know how to love you my way. You give me fever when you kiss me, fever when you hold me tight, fever in the morning, fever all through the night. Sun lights up the daytime, moon lights up the night. My eyes light up when you call my name, 'cause I know you're gonna treat me right. Bless my soul, I love you. Take this heart away. Take these arms I'll never use, and just believe in what my lips have to say. You give me fever when you kiss me.
Okay, I think that's about it, gang. I'm about out of energy here.
My give it to me tonight.
Let me wrap up the little Harlem Nocturne, and then we're going to wrap. And thank you guys for being here. Thanks so much. I appreciate it. Join my live room, trademastery.com/live. Oops, one more time. Practice, like Bennett said, got to practice. Doing a little giant steps there. It's also the name of a great book by Anthony Robbins. You guys have been great. Thanks for being here. Peace. I'm out. Take care and bye for next time. I appreciate you guys for being here. And thanks guys for hanging around. I appreciate it. And I'm on the other mic, so bye for now. Bye.